for me. You're starting to have these year-over-year declines in CPI, at least you should, just mechanically because of the base effects. How the Fed internalizes that and then projects the future for their dot plot, that's what I'm going to pay way more attention than just the next couple of months.
Especially because that will be the time when the wind downs of some of the balance sheets, the runoffs, start to accelerate and some of the rate hikes take effect. And a lot of people are waiting for that to truly gauge how significant the impact will be.
Let's get to Jay Bryson, the chief economist at Wells Fargo. Jay, let's start there. With the Federal Reserve this Wednesday and something that Lisa and I were talking about 30 minutes or so ago, where there is scope for surprise this Wednesday, where is the space for surprise?
You know, John, I think the scope for surprise on Wednesday is not so necessarily in terms of the rate hike. I mean, everyone's primed for 50 here. Is there a probability they could go 75? Yes, there's a small probability of that. I think the bigger chance, though, is in terms of the QE. How big is it that they're going to let the caps be there? I mean, we're expecting a $40 billion cap in terms of treasuries. We're expecting a $25 billion cap in terms of mortgage backs. But, potentially they could go bigger than that. And so I think that's kind of where the scope for surprises. And then the other thing I think, is what does Chairman Powell say in his press conference afterwards? Does he come off really hawkish in terms of the press conference as well? So those would be the two places I'd be looking for.
What do you view as the Fed's goal if they make a higher cap in terms of how quickly the Fed rolls off the balance sheet? Do you have a sense of the economic ramifications more clearly now than, say, 3 months ago?
So, I think in terms of that, what they're trying, I think what they want to do there, they want to show that they're really serious about tightening here is kind of what they want to do. And frankly, when you look at the mortgage-backed securities, those caps really aren't going to bind right now because there's very little paydowns going on in terms of mortgage-backed. So if they do a 25 cap or a 20 cap, most of those caps aren't going to bind, at least right away. And so I think it's the signal that they're trying to send here. Hey, look, we're really serious about inflation. And so that's why we think they're going to come out a little bit more aggressive in terms of the caps. Again, not because they're going to be binding, but it's just the signal that they're sending.
What's the signal being sent by companies? We're more than halfway through first quarter earnings season. We've heard a lot of forward projections that were somewhat negative, even though the earnings have actually been really quite optimistic. I mean, is there anything that the Fed is going to kind of hone in on as important for their forward-looking outlook?
Yeah, so that's a good question, and I think there's clearly information in terms of what companies are saying going forward, and I would take the earnings season so far as kind of mixed, at this point. And you folks were saying earlier about the next few months they're not data dependent. I largely agree with that, but I think when you look out to again back to John's point, when you look out to the summer, if you look at July or something like that, that's when they really start to become data dependent. How has the economy performed over the second quarter? How has inflation come in over the second quarter? And so that's going to be key for me.
What about the data that we're seeing elsewhere, Jay, like China over the weekend, the worst PMI readings on both manufacturing and services since February of 2020, the peak of the pandemic lockdowns there. Do you view China as a greater growth risk or inflationary one, considering that also exacerbates some of these supply chain issues?
So that's a good question. I think it's a little bit of both. And I think, I guess the bigger risk here for us in the United States would be the supply chain. If you look at what we send to China in terms of exports, it's about $100 billion a year. If you put that into GDP terms, it's less than a 0.5% of GDP. And so the bigger issues, the place that we're a little bit more dependent on China would be in terms of the supply chain. And so, I look at that, at least in the near term, as being the biggest risk. Case counts are coming down in China right now. I wouldn't expect the lockdowns to continue indefinitely. But, if you do have some supply chain issues there over the next few months, in the near term, it certainly exacerbates the inflation situation here in the United States.
Yeah, and of course, the pandemic kind of dropped out of the Fed's commentary at all in the March meeting, except for noting that is the reason, in large part, for the inflationary forces that we're seeing. I wonder if it comes back in relation to China. Jay, just finally, do you expect that Chairman Powell will indicate whether or not he thinks the Fed needs to go beyond neutral, that they need to get restrictive? Will we get a clear signal of that on Wednesday?
I think he's going to be a little bit more hedgy in terms of that. He's kind of in the middle of the spectrum in terms of the doves and the hawks. The people like President Bullard, President George, the people like that, are talking a very, very hawkish line right now. I think, Chairman Powell, he's going to be speaking for the committee. He's not going to be speaking for himself when he talks on Wednesday. And on the committee, there's a little bit of a split there, whether or not they should go beyond, if they go into restrictive territory or not. So I think he's going to be very careful with what he says about that, again, because he's speaking for the committee and not for himself.
Jay, awesome to catch up, buddy, as always. Jay Bryson there of Wells Fargo. And Jay finishing that conversation, I think, on a really, really important point. We know where there is a consensus on this Federal Reserve. Let's get back to what they think is neutral. After that, that's where there is division. So there will be division, Lisa, to some degree, around the outlook after you get to neutral. And the chairman's job in a news conference like this one is to try and reflect the consensus on the committee. It's hard to reflect the consensus on the committee when there isn't one on a key part of the story through the next year or so.
Which is the reason why his goal has been to say as little as possible at so many news conferences, and probably will be the same. This is the official consensus that we came to, and I can't really tell you anything else, because that really has basically been the message so far. At least that's what I've gotten, and especially from the panoply of different Fed speakers. They stick to their guns, and you don't necessarily get that consensus in the forward look.
Is there anything left to unveil on QT? Are we comfortable now with the numbers? Do we know what's coming down?
I don't know. My biggest question is, what's the circuit breaker? Just in general, what kind of financial condition tightening would make them stop? When do they get nervous? Is there a Fed put at some point, and where is it? If not, what are they looking to do? Are they looking to create some disruption, or are they okay with more disruption than we've seen in years that are tied to the Fed policy? To me, that is still a question.
These are the two questions I think we're asking. Will the Fed blink? Will China back off from zero COVID? They've got to be two of the biggest questions for the global economy at the moment. Standard Chartered say on question one, they don't see that happening until Q3 2022 for the Fed. For China, they don't see them blinking until at least after the 20th Congress of the Chinese Communist Party, likely to be held in the fall. So these are Q3, Q4 questions, Kayleigh. We might not get those answers until later this year.
So it's going to be a long couple months is essentially what we're looking at here, John. And I think to the point on China, China thinks potentially that they are going to be able to maintain zero COVID because they can provide support for the Chinese economy through easier monetary policy, through infrastructure spending. I think the question is, how much will that be successful, considering, A, it's just words for now, there still is no action, and how much does it help an economy if a large part of it is still in lockdown?
That PMI number got buried going into the weekend. Manufacturing, 47.4. down from 49.5 in March. Non-manufacturing PMI in China, 41.9, down from March's 48.4. Some of the lowest readings we've seen in a couple of years. Futures positive 0.5% on the S&P this morning. Good morning to you all. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world, here's the first word. House Speaker Nancy Pelosi has told Ukraine's president that, quote, your fight is a fight for everyone. Pelosi became the highest-ranked American official to travel to the country since Russia's invasion. She told Volodymyr Zelensky that the U.S. is committed to be there for Ukraine until the fight is done. Germany says that sanctions against Russia can be lifted only when its forces leave Ukraine. Foreign Minister Annalena Baerbock says that includes Crimea, which Russia annexed in 2014. Moscow would be unlikely to give up that region. In India, a blistering heat wave has scorched wheat fields. That's reducing yields in the world's second biggest grower and could be a serious blow to global wheat supplies after Russia's war in Ukraine upended trade flows out of the Black Sea breadbasket region. Qantas has revived a plan for the world's longest nonstop flights. They would connect Australia's East Coast with New York and London. The airline says it's buying 12 Airbus A350-1000s that can make the 20-hour journeys. Qantas will begin service from Sydney in 2015. Warren Buffett is buying big. Berkshire Hathaway made $41 billion worth of net purchases in the first quarter. That's the most in at least a decade. Berkshire boosted its stakes in Chevron and video game maker Activision Blizzard. And the creator of the popular Bored Ape Yacht Club NFTs launched a sale of virtual land over the weekend that crashed the Ethereum blockchain. It also raised about $320 million worth of cryptocurrency in the largest offering of its kind. Users scrambled for deeds to 55,000 parcels of land in Otherside, Yuga Labs' highly anticipated metaverse project. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kayleigh Lines. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We are trying and we're doing everything possible on the battlefield, but also on the diplomatic front to stop this war as soon as possible. But as this war was started by Russians, it has to be ended by Russians. And we really hope that they will make that decision faster.
Oksana Marakova there, the Ukraine ambassador to the US on ABC over the weekend. From New York City this morning, good morning. Equity futures look like this Monday morning, up 0.4% on the S&P 500, positive 16 points. On the NASDAQ 100, up 0.5% after a really ugly month of April for the equity market bulls. In the commodity market, crude, negative 2.7% on WTI to 101 and about 90 cents. Bit of news out of Germany, Katie, in the last couple of moments or so.
Yeah, from Christian Lindner, the country's finance minister, saying that an immediate Russian oil embargo is possible. This is according to Die Welt, which is a German newspaper. Of course, we just learned last week that Germany wasn't going to stand in the way of a wider European embargo, John, but they had said that they were prepared to back a gradual reduction, not necessarily an immediate one. So that actually is an interesting change of tone. The question is, though, it's no longer just Germany that could have stood in the way. Now the issue has shifted from them over to Hungary, with Viktor Orban saying that a veto might be possible.
Likely to just come at the individual country level, you'd imagine, Lisa. Some countries have already made that decision to cut back on Russian gas, Russian oil. You'd imagine that if this decision is made, it's going to be difficult to make it at the European level, given where the Hungarians are right now.
Yes, although if Germany does it, how much does that count for most of Europe, given how much they rely on Russia for their oil and gas? How much really are they the elephant and everybody else is peripheral? And sure, if they don't get on board, it just basically is noise around the edges.
Well, the oil discussion, isn't that noise relative to the gas story?
I would think so, yes. Although it does have an implication, and definitely people are saying that an oil embargo would have some effect on the overall market. But still, you are correct. This is a gas issue, 100%.
Let's get to Liana Fix on some of this, the program director at the Korba Foundation. Liana, great to catch up with you. A lot of people have pondered various conclusions to this tragic war developing in Ukraine. You've pondered this one. What if the war in Ukraine does not end? Can you run us through your thinking?
Yeah, absolutely. Thank you. My colleague Michael Kimmich and I, we tried to think through, if the war doesn't end and become a protracted conflict, whose side is time on? And our answer would be that it might be favorable for Russia to keep the war going on and to drag on with the fighting, because it might be better than accepting a humiliating defeat. For Ukraine, it would be obviously a terrible outcome, because it would mean that vast territories in Ukraine would be devastated, but it would also be a challenge for the West if the war continues not only for months, but perhaps for years, because Western societies would have to keep up support for Ukraine, support for this war effort, even if we might see an economic recession and other painful domestic measures.
Liana, how does that potential outlook affect Europe, the European continent, if the war just doesn't end in terms of this protracted, slow bleed of war and strife?
It will be a continuous security risk just on the border of NATO and the European Union. And it will certainly give Europeans the feeling that they are under constant threat of escalation with Russia. And that is certainly something that Moscow wants to achieve. They want to project power beyond Ukraine and to demonstrate to Europe that if they would want to, they could go further ahead, perhaps towards Moldova, that has already been mentioned by the Russian side. But it would also mean for Europe economic pain, and that we just discussed the oil and gas embargo. That is important for political leaders to explain why this is not only a step taken out of support or altruism towards Ukraine, but it is a step that needs to be taken for Europe's own security, because if Russia wins in Ukraine, it will be emboldened to look further.
Is there any positive potential outcome? Is there any, not positive, because this is an all-around tragic situation, but a more constructive outlook that you have?
I think the most positive outcome would be that at some point Russia is pushed back closer to the lines of pre-February 24, and that at this point there is a negotiation situation between Ukraine and Russia which allows Ukraine to negotiate from a stronger position and not on Russian capitulation terms. And such a negotiated outcome, which would allow Ukraine to keep its independence, but also to keep its military, and to prevent that Russia just finishes the business in a couple of months or years that it has not been able to finish now. This position, a negotiated position from a stance of strength by Ukraine, that would be the best outcome that we could imagine right now.
Well, President Volodymyr Zelensky of Ukraine spoke to a German newspaper over the weekend, and he said, quote, "The war will end when we win." So that is his outlook on that. Given that you say that this could last for a long time, potentially this is a war that is of indefinite duration, what is the appropriate policy response from the West, to who this point have been given ample aid on military and just sheer economic basis to Ukraine, the Biden administration wanting to do another $33 billion? Does that have to continue into infinity as well?
I think Ukraine has demonstrated already at the beginning of the war that it is not opposed to negotiations. It has negotiated with the Russian side until the atrocities of Bucha, and it is certainly willing to continue negotiations if a position is reached where Russia would accept terms that keep Ukraine's independence and territorial integrity alive. But to come to this point where we can negotiate from this position, the West needs to continue to support Ukraine. And this means in the long term also supporting Ukraine with Western weapons, but of course also putting up pressure on Russia, and there the energy sanctions come into play. So the only way how to prevent that the war becomes a long and drawn out war is to continue support Ukraine and to prevent that this becomes a war of attrition, because Ukraine is just too weak to push Russia back from those new territories that they have conquered so far.
Liana, it sounds like to me you're saying that we need a ban on Russian gas. Is that right?
It is something which is already discussed in Europe and which is planned for in the mid to long term, an exit from Russian gas. The only question is if this exit, the timeline of the gas exit, actually overlaps with the timeline that Ukraine has, and whether exiting Russian gas can support Ukraine and the threat of exiting Russian gas can help Ukraine at the moment. I think the fact that Europe, and especially Germany, needs to end its dependence on Russian gas, that is something which is by now commonplace in almost all European capitals.
Really well framed, Liana, and fantastic to catch up with you. Liana Fix there of the Korba Foundation on the situation in Ukraine, and perhaps the timeline mismatch that we've got on our hands here, Lisa, between how long the Germans and the rest of Europe would like to take themselves off Russian gas and how long maybe Ukraine has.
Where does Germany get their gas? I mean, this is the big question. Do they get it from Qatar? And Qatar is actually forecasting a much bigger revenue chunk because of their increased exports of natural gas, but there just isn't enough yet coming online to really plug the hole, the gap of Russia truly being banned by Germany.
Here's a stat for you just on oil, and we're talking about the relevance or irrelevance of the prospect of cutting Russian oil. The team here at Bloomberg says Germany has already cut the share of Russian oil in total imports of the fuel to around 12%, down from about a third before the invasion of Ukraine, Lisa. So that's already a monster cut.
And that really isn't the main dependency, and they can probably get oil from other players, not just Russia.
From New York City this morning, good morning. This is Bloomberg Surveillance.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed is in warp speed in terms of trying to get to neutral and past neutral.
We no longer have ultra-accommodative Fed policy.
The Fed needs to get to above 3.5% on the Fed funds rate.
The big fear here on the Fed hiking cycle, that is something going to break?
They want to wake up one day and they want like inflation back to 2%. This is not how it's going to work.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from a stormy New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. TK out of the building. Back tomorrow, I'm told. In his seat, Katie Lyons alongside Lisa Abramowitz. I'm Jonathan Ferro. Futures up about 1/3%. Lisa, it is all about the Fed this week.
How much does the Fed actually signal a faster unwind of the balance sheet? Do they go 50 basis points? Yes, that's what we've all baked in. But do they signal the forward look, how far they are willing to go and what they are looking at in terms of the inflation projections for the end of next year?
How data dependent is this Federal Reserve for the next several months? 385 is the estimate on Friday on payrolls. Do you think anything that comes through in the next couple of months makes a difference to the trajectory of Fed hikes through this month, into next and beyond?
I don't know that it will come from the payrolls report, perhaps on the inflation side, just to get a sense of how entrenched the payroll inflation actually is. When it comes to supply chain disruptions, when it comes to China, when it comes to perhaps higher oil and gas prices, should there be some sort of embargo on Russian energy products, could that shift the narrative on the Fed, frankly, more than the tightening labor market?
Will the market make them blink? Because Katie Lyons, last month was brutal.
It was really, really ugly. The worst month we've seen for equities going back to 2020. Actually, the worst April for the S&P 500 since 1970. For the NASDAQ, the worst month since 2008. And that was even in the face of earnings, John, that by and large have actually been okay. You have the vast majority of companies beating to the upside. You're seeing 15% sales growth, 3% earnings growth. And yet that has not given any support really whatsoever to this equity market.
It hasn't made a difference, has it, Kaylee? Why is that? Why do you think that is? Margins have held up pretty decently. The earnings are there. The outlook, yes, it's muddy, but at the moment, people just aren't buying the good news. They're focused on the prospect of it turning bad.
Yeah, people are looking out longer term, seeing net revisions rolling over actually in negative territory, not just for the U.S. and globally, and saying that the picture doesn't look all that rosy when you look beyond what happened in the first quarter, which a large part of it was before Russia invaded Ukraine and before we got a lot of the hawkishness that has emerged from this Federal Reserve.
Not just about the outlook, though, Lisa. It's about the reality of the here and now. And the reality of the here and now in China is not great. The manufacturing PMI at 47, a 41 handle on the non-manufacturing gauge is not pretty reading.
And frankly, the main effect on the United States will be the supply chain disruptions. The main effect on Europe will be more substantial and a greater hit. I wonder if we're overthinking this, though. Perhaps the reason why stocks are down is because benchmark rates are up so much and the relative valuations have just gotten a lot less attractive. How much is that really the main driving feature at a time when the dollar keeps strengthening? And frankly, people are completely readjusting their sense of what's normal when it comes to the backdrop of the cost of money.
Stocks down, bonds down, painful month behind us. What's in front of us? We'll catch up with Jim and Emmanuel in just a moment. Futures look like this, up 1/3% on the S&P. On the NASDAQ 100, up 0.5%. Yields just a little bit lower, as Lisa pointed out, much higher through the last month on 2s and 10s. On 10s right now, 291.24, and crude, negative about 3%, Bramo, 101.61.
All right, here's what I'm looking at today. Today, the EU energy ministers are holding an emergency meeting to try to understand and perhaps get some sort of consensus in the region's approach toward Russia. They have a meeting at 9 a.m., 11 a.m. press conference. How much do they get a consensus with respect to a timeline for gas? It is all about natural gas. Natural gas prices well below the year-to-date highs, which I find fascinating at a time when, frankly, people are saying that they need to move away from gas, and it doesn't seem likely that they are going to do it in the very near term. Today, the Milken Institute Global Conference is beginning. First day in Los Angeles. Among those speaking, Jane Fraser of Citigroup CEO. She will be on Bloomberg Television later, as well as Mark Adanazio of Crescent Capital and James Zelter of Apollo Global. How much do they signal a doubling down on risk following the worst sell-off going back to 2008, which we saw in April. How much is this a buying opportunity versus a shot across the bow ahead of even more volatility ahead? And today, the earnings parade continues. Here's my question. Has there been enough weakness baked into some of the pandemic darlings? Zoom Info, for example, down 26% year to date. And has there been too much optimism baked into some of the reopening stocks like Avis Budget and others, which is up 29% year to date? And I ask this because where is the dynamism going forward at a time when you've got supply chain disruptions, you have the Chinese slowdown, and you already have an outperformance that is so bifurcated in a market still full of uncertainty, John?
That's your question. Here's the big question for our audience at the moment. Did Tom Keene take off because the Red Sox lost to the Orioles? Someone else goes on to say they destroyed the Red Sox. Just curious, because he has no problem bashing the Birds from Baltimore. Will he discuss the big loss? TK's on day 2 of a hangover. On day 3 of a hangover, when he's forced to come back into work, I'm going to ask him about the Red Sox, Kayleigh.
All right, you do that, John.
We'll
I look forward to his reaction.
I look forward to his reaction. His Tots won, though. I can't believe I call Spurs Tots, but his football team won. So he's a happy man. You can hear Julian Emmanuel.
Yeah, that was gold.
Let's get to Julian Emmanuel of Evercore. Julian, your view is that this is a market of stocks. It's not about the index. Walk me through your thinking.
So, look, going back to this whole idea of a rising cost of capital is clearly the combination of yields moving higher and inflation moving out of a 25-year range has changed the correlation between stocks and bonds. Risk on, risk off doesn't exist anymore now. It is risk on, and lately risk off, risk off. And in that kind of environment, interestingly enough, with volatility where it is, correlation has been low. Picking stocks wins the day. It's no longer an index game. And from our point of view, there's a whole group of stocks out there who actually have had their earnings estimates revised higher and still have, a situation where they've been crushed year to date. And that's where the attractiveness lies for us.
Okay, so these are specific stocks. First of all, can you mention which ones you see the biggest opportunities in?
Well, we'll say it's across a slew. The semiconductors have been hit very, very hard in general. And actually, if you go back to last week, there was several which had, in a season of very poor earnings responses, had good earnings responses. The home builders is literally the group that everyone loves to hate right now. Huge short interest there. And, to us, any sign, not even that rates are peaking, but that the level of ascent of rates is likely to moderate, which I think if Powell gives the market what it wants, you get to see that. Those are the places we think are worth a look.
Do you think that there have been pockets of capitulation already in this market? Is that basically what you're saying?
So profitless tech is certainly close to capitulation, but again, in a rising cost of capital environment, it doesn't necessarily mean that there's a buy, because if you look out 1, 2, 3 years, clearly refinancing is a more difficult concept going forward. But the problem here is, particularly when you think about this week, is it's very difficult to explain to the public that negative GDP print along with the large inflation numbers, and the public is the one that disproportionately owns FANG, which has been hurt in recent weeks.
Well, talking of the public, Julian, let's talk about the consumer, which by and large seems like it's holding in there, is tolerating higher prices, is allowing companies to exercise pricing power and retain margin. Do you expect that that's going to continue to be the narrative as we move forward through the remainder of this year?
So we at Evercore ISI do really on-the-ground survey work, literally day to day and week to week. And Ed Hyman's work is, try as we might to find material weakening, we don't see it. And so it's our view that if you look at sort of years like 2015 and 2016, the last time that an exogenous shock like China weakening spilled over into the U.S., it derailed the consumer very briefly and then just kept on going. And that's what we see.
Julian, before we run away, the conclusion of your thoughts, picking stocks wins the day. Yes and no. Julian, it's very, very difficult to pick stocks. Michael Backnick pointed out that the average drawdown of the average stock on the S&P 500 is 21.8%. The drawdown on the S&P is 13.5%. Julian, what do you say to people who maybe don't have the skill set to pick stocks or the track record to do so, and don't want to pay up the fees to see if someone's going to be successful or not through a very tricky 12 months, do we really want to give up on the index just now?
So I think what you do is you really need to take a different sort of look. First of all, it's our view that given the likelihood that you're still going to get above trend, and remember, trend pre-pandemic was 2% growth, that you're going to get above trend growth in the U.S. this year and next. You're going to get rising rates. You're going to have sustained high inflation. You want to tilt towards value. Value has outperformed this year after 15 years of underperformance. We think that continues. But John, look, the fact is that nothing lasts forever, and index exposure has literally won the day for 15, perhaps 20 years. We think that good active management, and this is where you got to do your research, is going to look very attractive going forward.
You know the problem people have, though, Julian, they've heard that over the last 15 years, and then passive won the day. Do you know where I'm coming from? That people have just heard this so many times. That is this really the regime change? Is it finally here?
Well, and I would argue that it is, simply because if you think about it again, we've had two other regime changes that people probably hadn't thought that could happen in the last 20 to 25 years. That is a bond market that is now reversed its bullish trend and is arguably having yields headed higher, as well as an inflation breakout. We think these things cause a rethink of the investment landscape.
Julian, awesome having you in the building as well.
Great
Stay safe as you exit the building, too, given the stormy weather in New York City. Julian Emanuel of Evercore ISI. That got missed on Saturday night at the White House Correspondents' Dinner. Trevor Noah wrapped up his speech and handed over to the president, said thank you to the president. Lisa, by saying, careful when you leave the building, this administration is not very good at handling evacuations.
Yes, you came up with a lot of snide.
I'm not sure anyone really heard it because they were clapping Kim, but the line was there.
He delivered very well. He has said a lot of wonderful zingers. Equal opportunity, but he also had some pretty warm words about the power of the First Amendment.
Futures, positive a third of 1% on the S&P. On the Nasdaq 100, up 0.4%. Yields just a little bit lower to kick off May, down 2 basis points, 290.85. Tom Keene out of the building. Kelly Lyons in the seat alongside Lisa Abramowitz. I'm Jonathan Ferro. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world, here's the first word. Federal Reserve Chair Jerome Powell could shift the needle this week on how high investors expect the central bank to raise interest rates to cool inflation. The Fed's expected to boost rates a half percentage point when its two-day meeting ends on Wednesday. Another half-point hike is expected in June. Inflation could push Powell to signal that policy may require a more restrictive stance. A warning from the IMF, inflation may turn out to be even faster than global central bankers anticipate. Deputy Managing Director Kenji Okumura tells Bloomberg that the risk is rising that inflation expectations drift away from central bank targets. He says the most important priority is to end the war in Ukraine. Coronavirus lockdowns in China are taking a significant toll on the country's economy. Over the weekend, official data showed that both manufacturing and services activity plunged in April to their worst levels in more than 2 years. Indexes for exports and imports also slumped. Hungary is drawing a red line. A senior minister in Prime Minister Viktor Orban's government says Hungary will never support extending EU sanctions to Russia's energy sector. Bloomberg's learned that the EU is set to propose a ban on Russian oil by the end of the year. And Warren Buffett is buying big. Berkshire Hathaway made $41 billion worth of net purchases in the first quarter. That's the most in at least a decade. Berkshire boosted its stakes in Chevron and video game maker Activision Blizzard. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
How high will the Fed go?
I have everything on the table right now.
25 or 50 basis points?
If we think it's appropriate.
It could be 25, it could be 50, it could be 75, it could be 1.
We'll tell you what you need to know.
It becomes a question of how fast and how far do they go with rates?
Does he choose to de-emphasize parts of this forecast?
I'm blown away by the conversations we're going to have.
We're going to discuss all of this coming up.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
I'm really excited to be here tonight with the only group of Americans with a lower approval rating than I have. But Republicans seem to support one fellow, some guy named Brandon. He's having a really good year, and I'm kind of happy for him.
I have to admit, at that point, I did burst out laughing. The President of the United States at a White House Correspondents' Dinner Saturday evening. Bramo, we were on a different table, but very close to each other. I couldn't stop laughing when he mentioned Brandon.
He's kind of happy for him. You know, he's not sure who he is. I really wonder about the preparation that goes into this.
I think he knows what that means now.
Of course he knows. I think he knew going into that as well.
Futures right now, positive about 0.1% on the S&P. We faded a little bit, up 0.2 on the NASDAQ. Yesterday, we were recovering. Tom Keen's still recovering. TK's going to be back tomorrow, I hope, ahead of a Federal Reserve decision on Wednesday, onto payrolls on Friday. Yields come in a couple of basis points on a 10-year to 291.44. And crude, Lisa, down about 3%, 101.42. The Germans making some noise this morning, saying they're open to a possible crude embargo. And we're a couple of months into this, aren't we? And they're open to it.
Well, yeah, but as you pointed out before, they've already cut back their oil imports quite significantly from Russia. Really, to me, the main story with oil is what's going on in China and those shutdowns and how much that will really affect the global demand-supply picture at a time when that's this world's second biggest economy and could potentially have a negative print on their GDP for the second quarter.
Joining us to discuss, I'll get my words out, Maria Tadeo in Brussels.
We didn't take the day off.
Anne-Marie
so
Horter
that
at the
explains
White
it.
House. Keeping my voice, Anne-Marie struggling to keep hers. Maria, let's start with you. Maria, the Germans open to doing something on crude. How quickly can they do it?
Look,
I think they want to do it very quickly, and if it was up to them, they would agree to this week. But I would note, however, the details. The fact that you agreed to this week, it doesn't mean the implementation will happen immediately. What the Germans say is that they would drop this veto if they get a transition phase for this, so that the German industry is able to adjust in a phase out that is gradual from now until the end of the year. But you alluded to something here that really is the key to this move and this change of heart from the Germans, is that they're already doing a lot of structural changes to their dependency from Russia. Yesterday, they put out a set of data in which, well, the numbers just speak for themselves. Oil imported from Russia to Germany has dropped from 35% to 15%. When you look at gas, of course, it's more, it's 55%, now dropped to 35%, but you're seeing huge changes already from Germany. So for them, you know, if you want to drop it from 12 by the end of the year, go to 0, it does seem feasible at this point.
Where's Germany getting their gas from as they try to move away from Russia?
Look, I think oil, and again, I know you asked me about gas, but, you know, just very quickly on oil, we know that in terms of the transportation for this, it is way easier. So therefore, they're making grounds here when it comes to gas. And it's a very good question, Lisa. Of course, the structure, the infrastructure is connected to Russia. A lot of transit nations, the feed of Russia. And for the time being, it's not very clear where Germany can really close and narrow that gap. We have seen the German Vice Chancellor, Robert Habeck, who will be here in a few hours' time, by the way, on a plane to many different places, also in the Middle East, trying to get all of these deals. But, you know, for gas, it is very tricky for Germany. They've made a significant reduction, but to go down to 0, I think that's going to be very tricky.
And what about from the U.S. perspective, Anne-Marie? I know that there's been a lot of discussion about, obviously, the release of oil from the reserves in the United States. But what about the Biden administration's approach to supporting output, particularly with natural gas, because the investment is so significant, because it is subject to a lot of weather issues, and because, frankly, it has a national security importance, international security importance with Germany now that it didn't have a couple of years ago?
Well, we really saw the administration take almost a 180 on how they're communicating to the natural gas producers and the oil patch in the United States because of this wartime effort. But when it comes to LNG, we should note the U.S. is a massive exporter of LNG, and a lot of LNG has been shipped over to Europe. The president as well announced with Ursula von der Leyen the fact that they are going to increase that by the end of this year. The issue Europe has, of course, with importing tons of LNG, whether or not it's from the United States, it's from Qatar, or Tokyo is willing to move a tanker and give it to Europe instead of intaking it themselves because they are on long-term contracts with Doha, is the fact that Europe is just not set up strategically. The issue with natural gas is it's an entire structural issue. You need these terminal issues for liquefied natural gas, and Germany is still building them. So this is a major, major issue. So when Maria says we're likely not to go down to 0, it is going to take years.
Yeah, it's an infrastructure problem. Meanwhile, Anne-Marie, of course, you had Nancy Pelosi, the House Speaker, making that surprise visit to Kyiv over the weekend. I don't believe she'll return right back to Capitol Hill as the House is in their districts this week. When are we expecting action on that $33 billion in aid for Ukraine that President Biden has asked for?
Yeah, and Speaker Pelosi today sitting down with President Duda as well in Poland, talking about the NATO alliance. You can see the United States really wants to make sure they are fortifying that relationship, not just with Kiev, but the important allies that are surrounding Ukraine. So it's a great question, Kaylee, because this trip is on the heels of that $33 billion pitch. The president is asking appropriations from Congress because they are drawing down on that money. Usually it starts in the House, but because there really is this sense of urgency on Capitol Hill, we could potentially see the Senate take up that bill first. You're going to see a lot of bipartisan support for this, but potentially $33 billion, that top-line figure, you might have Republicans nitpicking some of the issues that are going into that. So it will start in the Senate likely this time because, as you mentioned, the House are back at their districts.
AMH, great work as always, outside the White House, down in Washington, D.C., alongside Maria Tadeo in Brussels. Just working through some of the calls this morning, some of the morning calls on the south side. This from Mizuho. We anticipate the negative impact to spread across all segments of internet, including e-commerce, advertising, and cloud computing. They are talking about lockdowns in China. Lisa, and these are the cuts. Baidu, the price target cut to 285 from 300. This is the US-listed Chinese stocks that they cut this morning. JD cut to 90 from 100. Alibaba, 160 from 180. They believe that's the story right now, and I think a lot of people might agree.
People would agree. At the same time, we have heard from Chinese officials some sort of support for their tech giants, not the U.S. tech giants that rely completely on the supply chains out of China, but their own tech companies. But how do they compete with the fact that you're looking at such a substantial slowdown with people just in lockdown? And frankly, even if they were to order something, could they actually even get it? Because who's out there even delivering it?
I know. Bear in mind, these are price target cuts, and their overall ratings don't change on some of these names, including JD and Baidu, which remain their top picks. They say, we anticipate both companies to be market share gainers from regulatory policies, which you just talked about, and competitive environment. Is there much of a competitive environment there at the moment? We can talk about that another time. Leslie Falconio of UBS is going to be joining us very shortly. Futures up a couple of tenths of 1% on the S&P, on the Nasdaq up by 0.2%. For our audience worldwide on TV and radio, this is Bloomberg Surveillance.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Can't believe it's May, still recovering from April, and will be for the rest of this month into June. Equity futures up a little more than 0.1% on the S&P. On the month, you know the story last month, the worst month on the S&P 500 going back to 2020. On the Nasdaq, the worst month on the Nasdaq 100 going back to 2008. Here are the year-to-date figures right now. On the S&P, we're down by 13% and some. On the Nasdaq 100, down by more than 21 percentage points. Things have felt worse than this on the S&P 500. Michael Batnick over at Ritholtz writing about that and saying that actually the average stock on the S&P is down by more than 21%. So maybe that captures some of that feeling you've got about the last month. The other part of the story as well is that equities were down and bonds were lower too. You didn't find that offset in the bond market. Maybe you found it if you were long the dollar in the FX market. We'll talk about that a little bit later. This is how the bond market is set up going into the Federal Reserve this Wednesday. The intraday high on a 2-year so far this year is about 7 basis points north of where we are right now, 271.49. On a 10-year, we had a gap higher last month on a 10-year yield. And I think, Lisa, that is where the surprise was for some. Not the move on a 2-year, which was elevated, but the fact we got some steepness back through the curve with that move on a 10-year.
People were increasingly worried that the Fed would not be able to get inflation under control, that they would remain behind the curve for longer. That was the big shift in April. Have we reached peak hawkishness when it comes not just to the Fed policy, but how much inflation really will gain traction over the longer term?
Your 10-year right now, 291.63. We'll pick up on some of those themes in just a moment. That's the cross-asset price action. Let's get you some single names, some movers. We can say good morning to Kriti Gupta. Morning, Kriti.
Yeah, good morning, John. We'll start off with the big tech picture because right off the bat, you have some pain in Apple shares down about 0.2%. It was down as much as 3% earlier in the session. So you can see some of those losses have gotten paired. This, of course, comes after an EU complaint about Apple restricting technology, allowing payments directly from your iPhone. So we're going to keep an eye on that story. And sticking with the tech theme, let's talk about Microsoft here, up 0.1%. This is not the conviction move you want in futures trading if you were looking for a positive open. Remember, you just talked about that pretty rough month of April. Do we start off May with a bang? That's the question. And I really want to stick with the Microsoft Activision theme here because one of the big stories over the weekend was the Buffett bid, the annual shareholder meeting for Berkshire Hathaway, where Warren Buffett talked about the arbitrage deal he's looking for Activision Blizzard. Remember, Microsoft coming in and saying they're going to buy Activision Blizzard for $95 a share. Yet, those shares are still trading around $77. So you do see a massive bid here coming off those comments from Warren Buffett. Let's talk about the other names that Warren Buffett has actually been talking about as well, and that is building a stake in Chevron. Remember, he's already been building a stake in Occidental, partly funding their acquisition of Anadarko. Now he's doing a similar thing in Chevron. Nevertheless, it's that growth story in China that outweighs the Buffett bid this morning, and you can see that those oil names, as well as the copper names like Freeport and McMoran, those are all down on those China growth fears.
I gotta say, Kriti, what stands out to me as a 91-year-old founder, in addition to some of his 90-plus-year-old fellow officers, talking about how it's fair to show everyone they still are alive and kicking. Kriti, thank you so much. That was one of the main themes, frankly, of the affair, where he also talked about that. What?
He appears to let everyone know he's alive.
Well, he said, it's fair, to let you guys see us, that we're here and we're just fine.
Every weekend they do this, I mute it on Twitter.
I know you do.
Every single weekend.
I know, but I actually think it was interesting that they were buying stocks because of the inflation call, not necessarily because of value. I thought that was interesting. But talking about the inflation call and where we are as we reset into May, really one of the key questions that I have is really about the 10-year. John, you were talking about that. Have we really priced in peak inflation fears over the longer term, not just the shorter term, but the longer term with the move that we've seen in the 10-year rates, and do you start buying? And Leslie Falconio, I'm really glad to have you here because you have actually weighed in pretty significantly, head of taxable fixed income strategy at UBS Global Wealth Management. You think it's time to start buying that 10-year treasury. What gives you that conviction?
Well, I definitely think it's time to get less short. We wouldn't probably go outright long here, and simply because the liquidity, as we know, has been very poor in the treasury market, plus the volatility is very high. But I do think as you get towards that 3.25, that fall of which are 2018 high, it is time to start scaling in. I mean, we've moved very quickly, and as we know, the market is pricing in 4 consecutive 50 basis point rate hikes in May, June, July. We've got, a 270 end of year Fed fund rate. We have 3.25 going into 2023. So there is a lot of hawkishness priced in here, not even including QT. So we do think it's time. We don't think you want to be short here. We definitely think there's value in the treasury market, but it's difficult to go outright long just simply because the liquidity and the volatility is so high due to the Fed.
What are you looking for, Leslie, on Wednesday when they give their guidance, when they raise rates by 50 basis points? Because I think it's fair that they're going to do that.
It is fair. I mean, yeah, obviously we think they go 50, probably 50 in June as well. You know, everyone's going to look at the for the Q&A and see how hawkish they actually are going forward, whether or not some of these 50s start to turn into potentially, 75. You know, in regards to QT, the key is going to be, we talk about the caps, but in our opinion, it's really about will they sell? And everyone looks at the mortgage rate and how high the mortgage rate has gone so quickly. But if you look at the equivalent level of 10-year yield back in 2018, back then the mortgage rate was much lower because the mortgage basis hadn't widened out so fast. So part of that rising in mortgage rate is because the basis has widened out. Now, if they choose to sell sooner than what the market's anticipating, I think that could be a pretty big headwind to the housing market.
All right, Leslie, while we're talking about the Fed, I know you said it doesn't really make sense now to be short at the longer end in 10-year. What about at the short end?
You know, we find value in the short end here, particularly when you look at things like IG corporates. We've had such a large rise in 2-year treasury yields. We're not calling for the high, but given the fact that we've moved so quickly with, 9-10 hikes expected this year, and we've seen such a large rise in the 2-year, and combined with some underperformance in some spread products such as investment-grade corporates, it's not a bad time to sort of take that incremental carry while your capital preservation is a little bit more protected now, given we've moved so violently higher in the 2-year.
Okay, well, let's talk then about the relationship between the short end and the long end. We saw a flatter yield curve. We saw a very briefly inverted yield curve. That is no longer the case. Where do you anticipate that trajectory goes from here?
I mean, more than likely by the end of the year, it's going to go flatter. And it's, if we look at 2s10s again, we normally when we're forecasting what, recession might be, we think the curve is a coincident indicator. We normally look at 3-month 10-year, but just for the purpose of looking at 2s10s, going forward, it'll more than likely, flatten out a bit. It could possibly invert, but that's mostly, in our opinion, going to be from the long end coming down, not necessarily the short end going up, given how aggressive these Fed rate hikes have been priced in.
Leslie, before we let you go, is this the best time to invest in riskier credit in a long time? And I say this because for so long, people were complaining about no yield. They were talking about how you can't really call these high yield bonds. They diminished the whole prospect of what the purpose is in these portfolios. And now I'm looking at high yield bonds with nearly a 7% average yield. I mean, this is actually real yield, getting to the point of perhaps even filling the bogey of a pension fund. What do you see in terms of value here?
There's no question from a income carry perspective, yields are very attractive now, finally. The fixed income market's been waiting a long time. But the problem is, even though fundamentals are very strong right now, those fundamentals are expecting a soft landing. So, spreads, although have widened out, they're not historically wide. So you really need to be cautious and pick your spot. I mean, we would really prefer to go up in quality here, given the cycle has really matured so fast and will continue to mature. So from a carry perspective, you're absolutely right. Yields are very attractive. But fundamentally, we think this is sort of the best we're going to see. And going forward, we might see some deterioration. Not a catalyst, but you'll probably see deterioration in fundamentals.
That's on the quality side, Leslie. What about on the duration side of things?
On the duration side, one of the things that we look at right now, we would take sort of that, duration over default type of allocations. I mean, we do expect that we think that on a duration perspective, again, we're not willing to get long yet, but you should incrementally start as we move to that 3.25. You should think about, getting longer. And particularly when we look at that intermediate part of the curve, that 5-year that's underperformed so aggressively, given the quick shift in monetary policy. So we like that intermediate part, but we're just not ready to go long yet.
Leslie, wonderful to hear from you, as always. Leslie Falconio there of UBS Global Wealth Management. Just on the bond side of things, we're just reading through the equity side of this story as well. Michael Batnick, I've referenced this piece from him a couple of times this morning over at Ritholtz. I think it's important to reflect on some of this, Lisa, that the drawdown we've had on the S&P 500 is 13.5% from the highs. But for many people, it feels much worse, and there is reason for that. There are several. The average stock in the S&P is down 21.8%, and Michael goes on to say more mental attention is spent on Moderna and Netflix and PayPal, which are all down 70%. Facebook and Nvidia are both down almost 50%, and that's where the focus seems to be because they are some of the most traded stocks out there. Some of the boring stuff has actually held up pretty decently.
So then do you start to go to stock picking? And you ask that question, do you really sort of lean into a strategy that time and time again has failed for so many people because they've not chosen the right stocks? Or do they stick with an index level bet at a time when there really is a lot of uncertainty? And I find that fascinating. I really like that question that you asked earlier, John, because I think about the banks. And so many people had such a high conviction about the banks heading into this year. And then they got their faces ripped off in Wall Street parlance because it basically went the exact opposite direction. How do you get the right call when you have, first of all, a very uncertain environment on an economic scale, but also uncertainty into how traders will really respond to that?
Stock picking is really difficult. And I try and put myself in the shoes of our audience who have heard this a million times over the last 10, 15 years, that it's the end of passive, it's the end of passive, it's time for stock picking. And then they've heard it for a 15th time in a 15th year running. And Lisa, this time around, I wonder how they're feeling about it. Do they really believe that this is the regime change that Julian Emmanuel was talking about?
On the flip side, I mean, you could be really skeptical, say it hasn't worked out for so many years. On the flip side, there has been such a massive divergence in the outlook for specific sectors. You think about energy and what's going on there. You think about, for example, some of the consumer staples being able to pass along the price increases versus some of the more volatile stocks, that you can understand why people are saying maybe this time is different.
Staples did hold up last month. Other things really didn't. In the face of rising yields, I think we've all expected that bank story, Lisa, that you keep bringing up, to perform, and it just has not performed, Katie Lyons, in the way that so many people lined up on this show and said it would.
Yeah, you're not seeing the response of higher yields, because while that may help them on the net interest income side, given there is a fear out there that the Fed may over-tighten, be too aggressive, and therefore lead the economy into a slowdown, if not an outright recession, that doesn't spell great things for loan growth. Joining us,
a master of the commodity market, Ed Morse, the global head of commodities research at Citi, a conversation you do not want to miss. With crude down 3% at 101.38 from New York City. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world, here's the first word. House Speaker Nancy Pelosi has told Ukraine's president that, quote, your fight is a fight for everyone. Pelosi became the highest-ranked American official to travel to the country since Russia's invasion. She told Volodymyr Zelensky that the U.S. is committed to be there for Ukraine until the fight is done. Germany says that sanctions against Russia can be lifted only when its forces leave Ukraine entirely. Foreign Minister Annalena Baerbock says that includes Crimea, which Russia annexed in 2014. Moscow would likely be unlikely to give up that region. Officials from rich countries are trying to pull together multi-billion-dollar packages to help poor countries phase out coal. They're trying to get it done before the next round of global climate talks in November. Negotiations have been snarled in part by Russia's war in Ukraine. The fighting has made coal a lucrative commodity to mine and export. In the Philippines, a new poll shows the son of the late dictator Ferdinand Marcos retained his lead in the presidential race. Ferdinand Bongbong Marcos Jr. holds a 56-23 lead over his closest rival, Vice President Leni Robredo. The election is set for May 9th. And the European Union has hit Apple with a formal antitrust suit over iPhone payments. The complaint alleges that Apple abuses its dominance over mobile wallets on its devices via its Apple Pay service. The company could face hefty fines. Apple says its contactless pay system helps consumers. And Warren Buffett is buying big. Berkshire Hathaway made $41 billion worth of net purchases in the first quarter. That's the most in at least a decade. Berkshire boosted its stakes in Chevron and video game maker Activision Blizzard. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
We need to see more production in the United States. The market provides every incentive that companies need to produce more, and we are encouraging companies to do so.
Good to catch up with Brian Deese, the director of the U.S. National Economic Council. A lot to discuss through the next several weeks on their next step as they try and do something about these really bad polls going into the midterms. Yields coming in a couple of basis points this morning. Good morning to you all at 291.63. Futures down about 0.1%. This move fades this morning. We started off positive. We're now negative on the Nasdaq too by 0.2%. A couple of stock stories out there, Katie Lyons. Let's get to Spirit, JetBlue and Frontier. Can we make a deal between at least two of these companies?
Yeah, that remains an open question, John. JetBlue, of course, had offered to buy Spirit for $33 a share, $3.6 billion. It is now offering an enhanced superior proposal to that, adding a divestiture commitment and a reverse breakup fee of $200 million, and says it would agree to divest assets if necessary. But of course, JetBlue was really the disruptor in what had already been an agreed upon Frontier Spirit deal. Frontier asking to buy that airline for $2.9 billion. So JetBlue had already initially offered more. Spirit Airlines board, though, coming out reiterating support for the merger with Frontier, not JetBlue, saying that the JetBlue offer is not the superior proposal. So it'll be interesting to see how this one shakes out. Not too much reaction in Spirit in the pre-market, trading at $23 a share, so $10 below what JetBlue has offered to pay for the company.
JetBlue has also not had a good time of it recently. They also failed to carry over my Mosaic status to 2022, which made some noise about and got absolutely nothing in return. That's another story. Do you want to talk about Frontier, Lisa? I know you have feelings and thoughts.
I don't think anyone needs to hear me and talk
you don't
about
want to share that, Ran?
Children's
we'll take a
experience
pass.
on Frontier.
Would you take the 20-hour flight on Qantas from Australia to New York? Would you do that?
You know, it depends if they have a track for me to run around inside. I think I could do it.
First class looks pretty decent.
Yeah, how much does that cost?
Get a whole bedroom.
I imagine it costs like tens of thousands of dollars, but you get a whole bedroom, Kaylee. You get a lie-down bed and a seat.
That I could do. Economy, 20 hours, no way.
I don't know. I could make that economy cabin work for 20 hours plus. That would hurt. We'll talk about that later. Ed Morse, Global Head of Commodities Research at Citi, joins us now. Ed, it's not all doom and gloom. Ed, you say on natural gas, this perfect storm shall pass. This market should loosen up later on. Ed, just walk us through the current thinking at Citi compared to the consensus view that I'm sure is giving you some pushback at the moment.
Well, on natural gas, we're getting a significant amount of pushback. The issue that we see is where markets are loosening up. And remember, we're dealing with a problem that's in the power generating sector, not at the moment in the transportation sector, not in buildings, not in industrial processes or agricultural processes, but very specific to fuels in the power gen sector. We're seeing China actually going all out for coal. They are already looking at producing 13.5% more coal this year than last year. They're adding 100 million tons of domestic production this year, and in the following 2 years, each another 100 million tons. That's going to displace imports into China, making coal available for the rest of the world. And at the same time, they're reducing their imports of natural gas. Year to date, they're way down. They have other supplies of natural gas other than LNG imports. They have pipeline gas from Uzbekistan, a big jump in pipeline gas from Russia. Their domestic production of gas went up around 6 or 7% last year. It's going to go up 8 to 10% this year. And they just simply need less natural gas. That's going to loosen up markets and provide a significant amount for Europe. So what we see happening is a progressive reduction in where European and global gas prices are, and along with that, gas prices in the U.S.
How much do you factor in, Ed, some sort of ban or overall embargo on Russian gas imports to Germany?
We actually think that's a very low likelihood on both sides, and if Germany is not going to use its veto power in the EU, Hungary certainly will. So we don't think there's going to be an overall European community agreement on not pulling in natural gas or oil from Russia. We don't think the Russians are going to pull back because income is better than no income. We actually think that, and that's another kind of controversial point, that where Russia is now, the volumes that Russia is now exporting of natural gas could go down, but they also could go up. There's tolerance in the contracts with European countries to add on above the take-or-pay contracts that they have. And if they added on what they could by contract, assuming that the ruble payment issue is dealt with, which we think it would be, actually more gas means lower prices. And if we get the volume right, it's lower revenue for Russia. So it's another strategy that may be not politically satisfactory, but it could actually work.
Ed, for so long, many months now, we've been focused on the supply equation, on how tight supply is. Now the conversation is shifting back, it seems, more so toward demand, especially when you see a Chinese economy that is looking incredibly weak in the face of persistent COVID-0 policy. How are you thinking about China and the demand story, not just for fuels, but also the metals as well?
Well, it's not just China in demand. There are other countries as well. But for China, it looks as though demand is down more than 1 million barrels a day year to date. It doesn't look like that's going to come back anytime soon. We think they're going to keep the blockage on international travel through the end of the year. So there's much less room for growth from China than people had thought. Certainly not the 700,000 barrels a day of growth that the OPEC Secretariat has been thinking that's going to come from China. We think it's going to be negative growth for the year, maybe not 1 million barrels a day under year on year, but a negative number. And it's also the U.S. where we've not seen demand increasing at the degree to which we would. Indeed, for the last 4 weeks on a 4-week moving average, U.S. gasoline demand is lower than any year in the last 5, except for that deep cut in demand during the 2020 deepest part of the pandemic. So U.S. demand has actually stalled out just as Chinese demand has been reduced. European demand is going to be lower. Emerging market demand is going to be lower. It would not be surprising to see significant projections going down for where demand is going for the rest of the year.
Just finish on supply in the US. It's been creeping up recently. Ed, where do you see that topping out? It's about 11.9 million barrels a day at the moment.
Yeah, and that's 900 a day year on year, by the way. We think it's going to keep growing at this rate through the end of the year. So if we add all liquids, including natural gas liquids, we've just raised our outlook for U.S. production to be 1.4 million barrels a day year on year, deck. We think it'll be getting very close to that 13 million barrel a day peak that we saw in the winter of 2019-2020. And the momentum that's built from that should be adding another million barrels a day in 2023. So we think that, one of the reasons for tight markets has been that drop in U.S. production, but U.S. production is coming back very strongly, and it would be even without the encouragement of the U.S. government.
Ed, thank you, sir, for catching up with us this morning with a bit of a different view on several topics. Ed Morse there of Citi. 11.9 at the moment, Lisa, and effectively Ed saying he thinks we get back to 13, a number we were at pre-pandemic.
Which actually does seem to be where we're headed if you look at how things are creeping up and the political pressure on a lot of these places, a lot of the producers to ramp up production. But it feeds into his idea that if you get more supplies, less demand from China, less demand even in the U.S., where do you end up?
Something we've got to keep on tracking. This is something the administration wants to see. And more recently, that output number stateside is creeping ever higher. Lisa Brabbits and Kelly Lyons, I'm Jonathan Ferro. Tom Keane back with us tomorrow to get you started for a big week ahead. The Fed and payrolls on deck.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number. And most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Clearly, the market is very worried right now. They are selling equities. I'm seeing a sea of red on this.
Of course, we've been on a roller coaster ride in terms of tech earnings.
All tech's in the penalty box. We're seeing a massive downswing post-pandemic hangover.
If you look over time, the equity markets are the place where you can cover your inflation.
We're in a pretty interesting part of the market cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good riddance to April from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz and Kenny Lyons, I'm Jonathan Ferro. Futures rolling over here, Bramo, now down 1/3% on the S&P.
Yeah, after a really brutal month, as you said, April, so saying goodbye perhaps not exactly to the sentiment. And, you know, we're looking at what's going on with China. We're now dealing with growth concerns. And I think this is an important shift. The first part of the year, the first quarter, was dominated by peak hawkishness, peak rate hike concerns, and now we're moving into a new area where people are worried about something more pernicious, perhaps.
It's funny, isn't it, when you talk about that relative to what people expect from, say, payrolls Friday, the ISM today. Here are the estimates from Bank of America. The ISM, 59, payrolls on Friday, 450K, unemployment on Friday, 3.5%, and a Federal Reserve that's going to go 50 basis points and implement QT. Does that sound like a bearish growth story at the moment, Lisa? I stress at the moment because the data points coming in that they're looking for, they're pretty decent.
And as we heard from Julie and Emmanuel, there are no signs that the consumer is slowing down. You can try to look for bearishness across the board when it comes to how much people are spending, and you cannot find it. However, the projections from Apple, from Amazon, from some of the tech giants that see a lot of clouds out there and say that has not been reflected in the numbers yet, really did shock the markets and I think has staying power in terms of sentiment.
Kaylee, the market has to anticipate, and last month it was anticipating some pretty bad things.
Yeah, it was. And that wasn't just true in the equity market, John. It was true in the bond market as well, in that a 60-40 portfolio in April got absolutely battered. It was the worst month for global bonds going back to at least 1990. We know that for equities, it was the worst since the pandemic, even worse in the case of technology. So really, it was an area in which you didn't have anywhere to hide if you were invested in fixed income or equities. And as far as what the equity market is considering here, it is not just that hawkish Federal Reserve, but also the outlook for earnings going forward. First quarter, margins held up fine. Is that going to continue to be the case as we move forward through the remainder of the year?
The only place to hide, Bramo, was in the FX market, getting locked the US dollar. We had a 5% move almost on the dollar index last month. That was a monster move.
Do you feel like we've made enough of this? I mean, yes, we've talked a lot about it, but
no.
I mean, and as far as the yen and the thresholds being crossed there, but in terms of what the financial stability and financial ramifications are of the dollar strengthening, have we really wrapped our heads around what that means for a world that is hinged on perhaps a dollar that isn't as strong as we're seeing it get to?
The Chinese lockdowns weren't talked about enough. They only started to get talked about in the market when we started to see some real weakness come through the Chinese currency. The euro-dollar story, sterling breaking down, barely featuring in the conversation either. The FX market screaming something over the last 30 days.
And frankly, a lot of people have said it's the U.S. Being able to raise rates more than Europe, but it's something more. It's the one haven people are finding amid that sea of red that Kaylee was talking about with 60-40 getting absolutely hammered.
Usually when you see this kind of dollar strength, it's not a good thing.
Exactly.
And that's reflective of what we saw in the equity market too. Equities right now down 1/3%. They were higher by 1/3% a little bit earlier this morning on the S&P. On the NASDAQ right now down 0.6%. Last month was ugly, 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 ugly. And if you're waking up in May thinking it gets better, it gets worse. We're down 0.6% again. Yields are down a basis point on a 10-year to 292. In the commodity market, just about holding on to 100 now, $100.96, down by 3.6%. The thing we're missing here, Lisa, as well, is credit. And as Lisa Falcone of UBS said a little bit earlier this morning, that spread widening that you might expect, given what we've seen in the equity market, wasn't really there in a massive way.
Yeah, and this is something Morgan Stanley really talked about in a recent Sunday note where they were talking about how a lot of the sell-off has really been driven by interest rates. And they see that shifting to now a little bit more of a growth concern being reflected with spreads widening out, even as perhaps some people start to see value in that rate story. And I do wonder whether we start to see that be the main narrative as we look into the second half of the year.
Let's get the Morgan Stanley conversation. We can catch up with Vishy Tripatur, the Global Director of Fixed Income Research at Morgan Stanley. Vishy, I read your note a couple of weekends ago, and you closed out a preference that's dominated much of this year. It was loans over high-yield bonds. That's closed out, Vishy. So set us up with what you were thinking coming into this year, how that market developed, and why you've closed out that position now.
Coming into the year, we thought the real risks to the credit markets are in terms of duration. The longer duration bonds, the investment grade bonds, are significantly longer duration. We thought were more exposed than the high yield bonds, which had a somewhat lower duration versus the investment grade bonds, and leveraged loans, which had the lowest duration of them all. So, and it has played out pretty much as we had expected. We thought for the first, until last week, the total returns were down 12% for investment grade, down 6% for high yield, and a slight positive 1.4% for leveraged loans. But we think now, incrementally, that duration as the main driver of underperformance is going to be not as significant, because we think a lot is already in price. A tremendous amount is in price in terms of monetary policy, the number of hikes, in however way you can measure. There is a lot of the aggressive monetary policy is reflected in price. Not to say that rates can't go higher from here, but incrementally, what has happened so far actually is going to be substantially higher than what we expect to happen in terms of duration. On the other hand, in terms of the economy, we are beginning to see some slowing of the economy. We are seeing margin pressures that Lisa was referring to just a minute ago. All of those things means that we should start paying greater attention to the tails of the credit markets. And the tails of the credit market, particularly in the sort of the CCC overextended part of the credit market, is where we want to be concerned about. So we have shifted our preference away from preferring loans that have a lot more direct exposure to incrementally higher cost of funding. That's the most exposed part. Compared to investment grade, we think where there is actually significant pockets of opportunity that have evolved as a consequence of this big rates move.
Vishy, how much is this a fundamental story that's tied to defaults that are expected to remain relatively few over the next couple of years simply because of refinancing mechanisms and the fact they've refinanced so much of their debt versus flows at a time when Japanese investors might be disincentivized to buy U.S. credit, U.S. debt more broadly?
I think fundamentally you're right, Lisa. Fundamentally we are at the beginning of a rate hike cycle. We have never had such strong fundamentals in any metric you can look at, debt to EBITDA or cash to debt or interest coverage. Across all these metrics, we have never been stronger at the onset of a hiking cycle. But that said, there is a point. So I'm fundamentally not tremendously concerned that we'll see a spike in defaults. But the defaults are such low levels. I think the preceding 12-month default rates are about 0.26% versus a long-term average, which is well over 3%. So defaults could go up, but not dramatically, nothing over nothing higher than the long-term average.
Vishy, how are you thinking about China and the potential ripple effects from what's happening in the property sector there?
I think on this thing we were. I must say that we were. Our expectations were off. I think I've spoken on this program before. We had anticipated a much greater support to come in sooner. That has not quite transpired. But I think the where I'm concerned more about China is the effect of a slowing China has on global growth, and that ripple effect is part of the narrative in our concern about growth slowing going forward.
Vishy, wonderful to hear from you, sir. As always, Vishy Tripatur there of Morgan Stanley. Just as we're having this conversation, Lisa, James Crombie of Bloomberg News messaged me and he said, IG total return down 5.5% last month. Worst April on record, worst month since March 2020. Losing streak now, 5 months, the longest since 1994.
It's been dramatic, and it's important to note this is the debt that's considered safest, right, within the corporate universe. The riskiest has done the best, and that is the shift now that Vishy Tirupattur was talking about. They're actually now more concerned about the stuff actually considered risky and less about the stuff considered safe when it comes to actually the credit profile. I'm curious about that, given where we are in terms of fundamentals.
Where do you think the Fed put is? I asked that question on Friday of several investors just trying to work out where they thought it was, and clearly the answer, the consensus is not here. And when we think about regime change, that's been the biggest change, hasn't it, Lisa? A move like this on the equity market, a move like this in total return and credit, the losses piling up, and still the belief that this Fed does not step in because they've barely got started on interest rates. QT hasn't even been initiated yet. That's something for later this week.
When you ask about the Fed put, I think it's really important to note that a lot of companies have already locked in their financing. How many companies actually need to borrow more money at this point in order to stay afloat, to refinance? And if you don't have that kind of real-time mechanism to bring in those higher borrowing costs to real corporate performance, what's going to be the check that's going to force the Fed's hand to actually force them to come in and to care, especially given how much liquidity is still out there?
Katie, if you asked someone to guess and they didn't know because they didn't follow the Federal Reserve, good for them, and didn't watch the news conferences, again, good for them, to guess how many times this Fed had hiked, what do you think they would guess versus what we've actually had so far?
I'd think that people would think we already where we expect them to end the year at neutral or possibly potentially above it, because this is still a Federal Reserve that is mostly just talking. We've only moved 25 basis points, and yet you have financial conditions that have now tightened once again to levels, putting the pandemic aside, we last saw in 2018. And they've had to do very little to actually get us to that place at this point.
Hard to believe that that's all we've moved, isn't it, Lisa?
Yes.
That's it. I mean, for all the talk, that's it.
Well, my favorite is looking at the balance sheet. People are talking about balance sheet runoff, and it's been, I mean, it's basically the same. It's the $9 trillion. The sort of decline is, you can see it if you squint really hard.
Futures are down this morning by 1/3%. Lucky to have Katie Lyons with us. Tom King back tomorrow. I'm Jonathan Ferro, together with the brilliant Lisa Abramowitz. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world, here's the first word. Hungary is drawing a red line. A senior minister in Prime Minister Viktor Orban's government says Hungary will never support extending EU sanctions to Russia's energy sector. Bloomberg has learned that the EU is set to propose a ban on Russian oil by the end of the year. Russian billionaire Oleg Tinkov reportedly is in hiding after criticizing his country's war in Ukraine. Tinkov told the New York Times the day after his Instagram post on the war, Vladimir Putin's administration contacted his executives and threatened to nationalize his bank. He tells the Times he ended up selling his 35% stake to another Russian billionaire in what he called a fire sale. A warning from the IMF, inflation may turn out to be even faster than global central bankers anticipate. Deputy Managing Director Kenji Okamura tells Bloomberg the risk is rising that inflation expectations drift away from central bank targets. He says the most important priority is to end the war in Ukraine. Coronavirus lockdowns in China are taking a significant toll on the country's economy. Over the weekend, official data showed that both manufacturing and services activity plunged in April to their worst levels in more than 2 years. Indexes for exports and imports also slumped. And the European Union has hit Apple with a formal antitrust suit over iPhone payments. The complaint alleges that Apple abuses its dominance over mobile wallets on its devices via its Apple Pay service. The company could face hefty fines. Apple says its contactless payment system helps consumers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
The Fed go?
I have everything on the table right now.
25 or 50 basis points?
If we think it's appropriate.
It could be 25, it could be 50, it could be 75, it could be 1.
We'll tell you what you need to know.
It becomes a question of how fast and how far do they go with rates?
Does he choose to de-emphasize parts of this forecast?
I'm blown away by the conversations we're going to have.
We're going to discuss all of this coming up.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
Pushback right now is no one wants to buy anything in tech. So it's not just Amazon. Go pull up a chart on Microsoft. Go pull up a chart on Google. Pull up a chart on anything. We are in a buyer's strike across Wall Street on software.
That was Brent Thill, the equity research analyst at Jefferies. There's been some big pushback, hasn't there, Lisa? We had the earnings, and on the street, the consensus view on some of these names still, Alphabet, prime example of that, still incredibly bullish on the south side. At the same time, you just got this monster feedback from the market that just says, no, thank you, we do not want it.
The buyer's strike is really palpable, and you really talked about that with the NASDAQ having its worst month going back to the end of 2008, and we're seeing it just not exactly people stepping in as it could be catching a falling knife.
They're not stepping in this morning, are they? We're down a third of 1% on the S&P. We were higher briefly earlier on the NASDAQ 100, down 0.4%. Yields coming in too by a couple of basis points. That's something a little different, I guess, given that last month stocks were down and bonds were down and yields are up. Right now, they're down just a little bit, 291.83. This gets your attention, down 3.7% now on crude to $100.85. Joining us now, an expert on all things in the stock market, Gina Martin-Adams, our chief equity strategist for Bloomberg Intelligence. The number one question, Gina, I guess, is how do we pick up the pieces through the month of May? What are you telling people?
Yeah, unfortunately, the technicals of the market are still very ugly. Even after Friday, you would think after such a capitulation sort of signal on Friday, we might pick up a better trend into this week. But there wasn't enough capitulation on Friday to get too excited. We're looking at things like 14-day RSI, which is still well above 30. Normally, you'd see that just crater down below 30 on a day like Friday. The percentage of stocks in the index trading above their 50-day moving average still just under 30%. For perspective, back at the lows in the pandemic, even the 2018 lows, we got below 2%. So there's just not a lot of evidence of pure capitulation in the market, which is usually what makes a bottom. At the same time, as you alluded to, these mega cap stocks in the index are a tremendous drag, and they're still dramatically overvalued relative to the rest of the index. They've got the 1-2 punch of rising interest rates and now weakening earnings trends to contend with. So it's just going to be very difficult for the index to gather any momentum. I think you need to either see a shift at the Federal Reserve, which frankly is just not coming, or an end to the war in Ukraine to create some reprieve in inflation for the market to get optimistic right now.
Well, with that
and
said,
those things aren't likely to happen.
All right, so with that said, Gina, and I know that you don't give necessarily a price target, but I wonder how much more downside there could potentially be before there is a sense of parity of valuation with the tech stocks and the rest of the market.
Yeah, it's really difficult to say, Lisa, because at this point in time, what our valuation models say is if we do see the 2-year Treasury yield march closer to 3%, which does seem to be the inevitable direction on the 2-year, you're likely to pay only 14 times forward earnings for the S&P 500. You're looking at an equal weighted index that's still close to 15 and a half times earnings. Overall market cap weighted index, it's closer to 17 times forward earnings. So that's a tremendous amount of fundamental downside if indeed the Fed is committed to take that 2-year Treasury to the level that the market thinks it's going to over the course of the next 12 months. You can make up for that with a much stronger earnings outlook. But unfortunately, as we found out over the last couple of weeks, even though 80% of companies in the index are beating expectations, those misses by the mega cap S&P 500 companies are dragging down the earnings outlook as well. We're looking at now second quarter earnings expectations for closer to 5.5% growth from where they were just a few weeks ago, which was just above 6.5%. And that downward revision to forward expectations is entirely coming from the mega cap stocks. So you can't find any sort of stability until we get closer to 4,000 on the S&P 500, where you start to see maybe some opportunities emerge. But frankly, if we can't get any kind of earnings stability or some signals that the Fed is going to stop at some point in the interest rate increases, it's very difficult to identify that low, that target low.
You sound pessimistic, Gina, but it doesn't necessarily mean that you're talking about recession. Can you parse out the difference between more downside risk in a price target and recession where you start to see a real contraction?
Well, look, I mean, your average drop in the equity market to indicate recession is close to 20%, right? However, we've had multiple corrections in the equity market that neared 20% that did not indicate recession over the course of the last decade alone. We had one in 2018 that did not lead to recession. We had one in 2015, 2016 that did not lead to recession. We had one in 2011 that did not lead to recession. So a 20% correction in the equity market can happen and not indicate recession is imminent. I think most economic models, including the models that the Fed would suggest recession is very unlikely until at least late 2023, maybe early 2024 at the earliest. That's difficult to say the equity market is pricing that right now. Instead, what the equity market is pricing down a material slowdown in earnings growth and some real damage to confidence for mega cap stocks at a point in time where the Fed is trying to catch up to economic reality. It's this confluence of events. It's creating a downdraft in equities. Frankly, it was entirely predictable. Most strategists were not expecting a great year in 2022.
Yeah.
The uncertainty that emerged is really that from the commodity complex and the persistence of inflation, partially as a result of the war in Ukraine. That certainly added a very different context to this market and creates greater downside pressure, along with now a shutdown in China. China, as sort of the producer of the world, is creating a tremendous amount of risk as well to supply chains, which we're supposed to start to clear up this year.
Well, and Gina, to that point, the one real safe place within the equity market to put your money this year has been energy. Far and away the outperformer, up 35% year to date. How much oxygen is there left in that trade considering issues like China?
Yeah, not a ton. I think it's a great question because what happens with the energy sector is it's very dependent upon what happens with oil prices. If oil prices are starting to peak, as we talked about this morning, oil's back down to around $100. You know, earlier this year, we were talking about 125, maybe 150 for oil prices. Some of that sentiment got embedded into the energy sector price. So you've got this near-term downdraft in energy, which is adding some pressure. Now, that said, energy stocks are still incredibly cheap relative to the rest of the market. As long as oil prices are going to maintain a level of about $100 into the longer term, you could still rely on energy stocks to contribute some degree of positivity to your overall equity portfolio. But in the short run, we're contending with a lot of volatility in oil price and some changes to expectations, which frankly is also weighing on energy sector earnings. I mean, we saw some big energy sector companies come out last week and not exactly provide not exactly positive news.
Expectations, yeah.
Right. So, you know, those misses are certainly dampening confidence as well. I think it's a more of a short-term reflection of what's happened with the oil price and the volatility there than anything. But if we can't maintain 100 on oil, we're going to see the energy stocks generally underperform as well.
What a tough time. Gina, thank you. Gina Martin-Adams there of Bloomberg Intelligence. And speaking to that index level story, Lisa, Energy's 4% of the S&P 500. You can pick a single name out on the S&P. Apple, the 7% of the S&P 500.
Well, yeah, it gives you a sense of how difficult it is to really position right now.
Futures down about 1/4% on S&P 500 futures from New York City on TV and radio. This is Bloomberg Surveillance.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning with Tom Keene at home and coming back tomorrow. Katie Lyons is stepping in alongside Lisa Bravitz. I'm Jonathan Ferro. Futures down about 0.1% on the S&P. For those of you writing in saying, be kind, let him have a day off. Watch what happens when I take a day off, a week off even, and see if you think I should still be kind. NASDAQ 100 futures down around about 29. We're down 0.2%. Yields coming in a couple of basis points, 291.83. Mike Wilson over at Morgan Stanley, the team, writing this on the equity side of things. Last week we suggested the bear market was entering the phase when virtually nothing would work, even defensives, based on the price action. That seems to be, Lisa, exactly what's happening.
Yeah, it's been a really, really rough moment for people because both bonds and stocks have sold off in tandem. And frankly, the only haven has been the dollar. Nothing seems to be working at a time when you've got the dueling ideas of inflation, a very hot labor market, as well as worries about some sort of downturn in the later half of the year.
This all ahead of the Federal Reserve on Wednesday and a payrolls report this coming Friday. Let's have that discussion with Kathy Bostjancic, the chief U.S. financial economist at Oxford Economics. Kathy, we love catching up with you. Let's get straight to Wednesday, that news conference. What do you expect to hear from Chairman Powell?
Thanks, John. Happy to be with you. Well, I think we're going to have to rely on the forward guidance and any tweaks to the policy statement because we're not going to be getting revised GDP or inflation or those infamous interest rate dot plot estimates. So, it really does come down to the messaging and any type of forward guidance he provides. Yeah, I think he is going to remain very hawkish. They're very worried about inflation. They see wage pressures picking up. So 50 basis points, done deal for Wednesday, and our view is probably another 50 basis points in June. We don't think they're quite ready to go 75, although I know the markets have been flirting with that.
Kathy, what do you think has the most potential to move markets? The Wednesday Fed meeting or the Friday payrolls report?
I would bet on the Fed meeting. Payrolls should be solid. The wage data probably actually takes front center, in terms of what's most important of the data, maybe also the labor force participation rate, because the view is, or at least our view is that as labor force conditions continue to improve, that's going to pull more workers into the labor force. You need that to keep a cap on wages going forward. So I think, really the Fed right now sets the stage for the financial markets and really also for the economy.
Kaylee asked a really good question earlier about what the bigger consequence from the China lockdowns would be for the U.S. economy, whether it would be faster inflation or slower growth. And the answer, unfortunately, is probably some dose of both of them. How are you viewing this with respect to the Fed and how much more difficult it makes their decision?
Definitely makes it more difficult. It's another stagflationary shock, even if we're not in stagflation per se, because we have stronger growth and momentum. Thankfully for the U.S. Still looks very good. The consumer spending data on Friday showed that consumers can actually outspend inflation, only by 0.2, but that's significant because it gives us a solid handoff to consumer spending in Q2. That all said, the Fed's looking at still a strong domestic demand backdrop. Supply chains are not correcting, as you highlighted, as quickly as we all thought or hoped. And on top of that, you have wages picking up a bit. So that's just going to keep them in a hawkish mood. And they're going to hope that they can tame inflation without, killing off the business expansion.
Well, Kathy, to your point on the consumer, that's not just something we're getting out of the economic data. You're hearing it from a large part of corporate America as well, that the consumer is hanging in there and is tolerant of higher prices. I'm wondering how long that can remain the case and if the American consumer and the support from it is actually going to allow and support the Fed in landing softly.
We think it can last for quite a bit, at least through this year. The household balance sheet's really strong, right? You have aggregate savings that were built up during the pandemic. They've tapped into a little bit. I mean, we estimate somewhere around $40 billion, but they built up $2.7 trillion. Leverage and debt is quite low. And you have the wealth gains from housing and even the equity market, even though it's faltering a little bit as of late, that still gives a powerful wealth effect. So we think it carries us at least through this year and even into next year, but it's really going to depend on the Fed. If they have to drive rates much higher, let's say 3 or 4%. That's not what we think. We think it's somewhere over, 260 or so on the Fed funds rate. But if they go higher than that, because inflation's stickier, that's going to be really difficult for the consumer and also for businesses.
How has your thinking on the balance sheet evolved, Kathy? And do you think that what we hear from the Federal Reserve on Wednesday on that front in particular can hold any surprises?
I think they'd rather not surprise us on that front. There's so much uncertainty around the rate forecast and outlook. They want to keep it as boring as possible. Of course, we know they've struggled to do that. It's not as boring as watching paint dry. So we expect that they'll, ramp up the balance sheet reduction. They'll start off with maybe 30 billion in treasuries, 15 billion in mortgage-backed securities, and eventually get to somewhere around 95 billion, which is what they floated right in the FOMC minutes, and it's largely what the markets are expecting.
Looking at the move in real yields taking place this morning, the high of the year happening right now on a closing basis, Lisa, on real yields, just about positive. Just about positive. We did that intraday, I think, in the last couple of weeks.
We did that intraday, but at the same time, people are looking for this being a more sustained move, and we haven't seen a more prolonged decline, 0.0154. This is actually interesting because it's been so deeply negative and was more than -1%, lower than -1%. As recently as March, this move has been dramatic as people really assess how tight the Fed would like to go. And really the ripple effects through equities, I've got to say, John, could be what we're seeing today in terms of the sentiment.
Kathy, I just want to come to you on this so-called Fed put and whether this Fed is truly data dependent. Bob Miller of BlackRock said to me on Friday that they don't have the luxury of being data dependent. Maybe they will later on in the year. Do you take that particular position as well? And when do you think they can become data dependent again?
It's a good question. I think they are data dependent. There's no doubt about it. But part of the data they're looking at are financial conditions, broad financial conditions. So that is going to include equity prices. That is going to include corporate bond spreads. It's going to include the dollar. So how they see financial conditions evolving is going to help them calibrate where they think the Fed funds rate is going to be. But, I think right now, front and center for them is taming inflation. And that's what we're going to hear for now. As we progress through 2022, and if things slow a little, they may pull back a little bit on that really hawkish rhetoric.
Kathy, what would be a restrictive Fed policy rate?
In our view, it's 2% is neutral. So anything above 2% will get you to restrictive. Now, the Federal Reserve thinks it's 2.4. So there's a little tension there. Markets probably a little closer to our view, frankly, but it's an unknown, right? It's an estimate. It's very difficult to really pin down precisely. But certainly once you get above 2%, that is going to have some ripple effects. And we see that right in the mortgage market, right? You see mortgage rates already jumping well above 5%. That is going to start to slow things down. So keep in mind what the market's done is already doing some of the work for the Federal Reserve.
And you've certainly seen that showing up in financial conditions. We were joking earlier, Kathy, that the Fed's only actually moved 25 basis points, and yet looking at the market, you may think they moved a lot more dramatically. Has the market done enough work that the Federal Reserve may actually have to be less aggressive than is currently the kind of consensus thinking?
Yeah, we think they're going to go less aggressive than the markets believe. When I looked at the Eurodollar curve, with the front end short-term rates, they were predicting a Fed funds rate topping out around 3% or so next year. Again, we think it's about 40 basis points lower, so it's in that ballpark. So I think, but the fears, the whisper fears that they'll have to go even higher, I think are unfounded. And we'll have to watch closely the financial conditions. We'll have to watch inflation. But if inflation's close to peaking, despite, the supply chain problems and aggregate demand for the consumers shifting from goods to services, that's really going to help the Fed out a lot, along with, the tightening in financial conditions.
That next CPI print, I think, coming up next week, isn't it, Lisa?
I believe so.
Is it on the 11th, is it?
I'm looking at it right now, and hold on a second. I will check that for you. But the CPI print will be important for the perhaps psychological impacts as well as the direction. Do you think it is the 11th. Do you think
I shouldn't have put you on the spot when I knew.
It's fine.
I kind of knew it was the 11th. I was just imagining you'd have confirmation.
Well, you imagine more of me than what actually happened. Thank you.
CPI.
Thank you, John.
CPI next week. We're
been a
talking
long
about
weekend.
that mechanical peak. You might just say thank you to Kathy. Kathy Voschansik's there. Thank you very much. Looking ahead to Wednesday in the Federal Reserve. Kathy's talking about the mechanical peak in CPI. We might have evidence that that's already happened when we get the print next week.
Does it matter? I mean, honestly, I wonder, does the mechanical peak actually matter, or does it mean the pace of the decline? And we were talking with Adam Posen, for example, about how it could get back down to maybe, 3% in 2024. Is that good enough for the Fed to feel comfortable, even if we did reach a mechanical peak, say, in March or April?
And that's the two sides of their goals of the Federal Reserve in conflict with each other by the end of the year. We're going to be talking about maybe an ISM close to 60 a little bit later this morning. Not my view, just the view of Bank of America. They see us getting to, say, 59. So let's say you've got that, something in the high 50s. Then you've got a payrolls report that shows payrolls growth in and around 350 to 400, unemployment in the threes. They're looking at this and saying, we've got a strong economy, inflation's too high, let's hike. Is that the same story at the end of the year? If inflation is 3, 4, 5% still, and they've got a growth story that's not as strong or robust or resilient, what do they choose between? And I think that's where the division is at the Federal Reserve, one, and in the market, two, Lisa. That kind of sums things up.
As well as how long does it take for monetary policy to actually transfer itself to sentiment and to a slowdown in the economy? How much lag time do they have to really use to judge what the efficacy is of some of their tightening?
Really looking forward to talking about some of this with Alicia Levine of BNY Mellon. We're going to do that around the opening bell at about 9:30 Eastern time, with an equity market that just is not holding up at the moment. We're down about 1/10% on the S&P, on the Nasdaq 100, down 1/3 of 1%. To Kaylee Lyons, thank you, Kaylee.
Thank you, John.
For jumping in the seat. Always great to catch up with you. TK will be in that chair tomorrow, we're told. I just can't guarantee anything. Yields on a 10-year come in almost a basis point, not even now, at 292.99. From New York City, for our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world, here's the first word. Germany says that sanctions against Russia can be lifted only when its forces leave Ukraine. Foreign Minister Annalena Baerbock says this includes Crimea, which Russia annexed in 2014. Moscow would be unlikely to give up that region. Officials from rich countries are trying to pull together multi-billion-dollar packages to help poor countries phase out coal. They're trying to get it done before the next round of global climate talks in November. Negotiations have been snarled in part by Russia's war in Ukraine. The fighting has made coal a lucrative commodity to mine and export. House Speaker Nancy Pelosi has told Ukraine's president that, quote, your fight is a fight for everyone. Pelosi became the highest-ranked American official to travel to the country since Russia's invasion. She told Volodymyr Zelensky that the U.S. is committed to be there for Ukraine until the fight is done. Spirit Airlines says it will go ahead with its deal with rival deep discounter Frontier.
Hello, traders. I'm going to place an order to buy euro. So if you want to trade right now euro, please place your order at 105.22.7. Okay, order placed, and stay with me. We will close this trade together. Let me place this order. 105.22.
The company's stock, Microsoft, of course, announced in January.
7. Sorry.
And
okay.
The European Union has hit Apple with a
If you want to get the strategy, you need to go to company.co.uk and you can get the strategy from there. Also, we have new date for the webinar. It's 12th of May. So if you want to register for the webinar, I will provide live. You can ask any questions you want. So feel free to write any questions you want to ask. Stay safe, guys, and I'll speak to you later.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Let's say you want to be positive if there's going to be China stimulus. Be very careful what you wish for, because if it's going to be a 2009 style credit stimulus and they go build, then supply chain issues, especially commodities, and the inflationary impact on that, you ain't seen nothing yet.
That was Jeffrey Yu, Senior EMEA Market Strategist at BNY Mellon. You ain't seen nothing yet. And what we have seen, at least overnight, was that manufacturing and services sector in China plunged to the lowest since February of 2020. This is the reported data. How bad are things getting as you start to get all of these shutdowns that are locking up the major economic engines of the second biggest economy in the world? Leland Miller tracks it on the ground, international CEO of the China Beige Book. Leland, how bad have things gotten economically in China? Not on an official level, but the unofficial nuts and bolts surveys that you do in the mainland.
Well, April was the first period in which the lockdowns really affected growth in a major way. And, what we saw from that was not just a tick down, in Shanghai or a tick down in Beijing. We saw widespread slowdown everywhere and pretty intensively. So it was not just services and retail flailing like what happened at the beginning of the, COVID shutdowns in China, where manufacturing is kept up and running. The big thing now is that manufacturing is being hit hard. Factories are being shut down by the lockdowns, not the outbreaks, but the lockdowns. And so you no longer have manufacturing pushing growth forward. At the same time, retail, services, and all these other sectors are flailing. So you've got widespread weakness right now, and there's no definitive timeline for when this will end.
What's your impression of the proposals that the Chinese authorities have put out there to potentially combat some of this weakness, given the fact that even if they, for example, have construction projects, who's going to be able to go out there and actually do them if they're locked down?
Well, this is what we've really been stressing for the past several weeks. There is definitely worry coming out of Beijing in terms of not just what the growth is going to be, but how you have a plausible story around there not being flailing results and flailing growth and a flailing overall governance performance. So there's talk, and this is why you saw the conversation move last week from monetary stimulus to moving into fiscal stimulus, all out fiscal stimulus. We're going to beat the USA in GDP. But like you said, if you're locking down all these major cities, if you're closing down the arteries between them, how do you do fiscal stimulus in a meaningful way? And so I think a lot of what you're seeing right now is still rah-rah rhetoric. It doesn't mean they're not going to move more and more into the fiscal side. We've seen that in our data for some time now. But the idea that they're going to all-out stimulus, they're going to recreate some of the conditions in previous party conditions year, it's way too early to make that jump.
All right, so it's talking the talk versus actually walking the walk to large part to this point, Leland. Something else that authorities have talked about, though, is wrapping up the regulatory crackdowns on industries like technology. Do you think that actually will come to fruition, and what difference will that make?
It might, but here's what investors really need to take note of. They are scrambling right now to send positive signals to markets, which is why you're seeing positive signals about a compromise over audits and delisting issues. You're seeing, positive signals about the regulatory crackdown ending. You're seeing positive signals about fiscal stimulus coming. It doesn't mean any of this is going to happen. I don't think any of this was part of their original trajectory for policy going into the party Congress. So they're saying this, and they're increasing sentiment, and they may cause people to run into the stock market for the 15th time this year. But are they actually doing this? It's too early to tell on this stuff. I think markets are getting ahead of themselves thinking that a pivot has already happened.
Well, and of course, you have seen some money coming back into Chinese equities, but still it's been absolutely brutal. And it does seem like that in large part is where policymakers are focused. We're also looking, though, Leland, at a Chinese yuan at its weakest against the dollar since November of 2020. How much weaker can it get?
Yuan, but the yuan has been range bound for years and years and years, and there are political numbers where they will not go past ultimately 7, but that may even be 6, 7 in the short term because they're trying to maintain stability here. The importance is you're not seeing the yuan fall off a cliff. You're seeing a supercharged dollar because of what you're seeing around the world: weakness in the euro, weakness in the yen, weakness in the yuan now. So you're not actually seeing a yuan disintegrate. You're seeing a dollar. And so there is not a rush to try to do something about this. There's, again, stability is the mandate. Stability is within a bound.
Leland, we're hearing from officials that we're looking to a 4 or perhaps 5 handle on GDP this year. What realistically is the GDP that you expect for China in 2022?
Hello? Sorry, I missed that.
What GDP do you think is realistic in China for 2022? Not the official one, but the actual one.
Look, if they can get lockdowns under control in the coming weeks, then they're going to still shoot for 4+. You still have Chinese economists right now talking about 5.5, which is rather silly. If they're shut down for all of May, then the question is there a plausible enough story for guiding this over 2? So I think what they want to do is they want to be able to claim that no matter how bad things get, they're still going to report 4. It's just a question of whether the lockdowns allow the optics for them to be able to announce that.
Leland Miller of China Beige Book, thank you so much. We always love having you on and to hear your insights and the more unofficial estimate of what things are happening in terms of the momentum in China. I gotta say, Kaylee, what he was saying before, what Leland was saying, that this is probably the most underplayed story out there, that if you have the world's second biggest economy possibly having a contraction in the second quarter and a 2 handle on GDP for this year, how do you then game out demand for commodities? How do you game out some of the supply chain disruptions that you're going to see around the world and really come to some sort of projection for global GDP?
Yeah, and on the demand and commodity side of the equation, Lisa, that's why you're seeing oil in large part down back at just $100 a barrel on WTI. You're seeing some weakness coming through in the metals as well off the back of this data. But again, is it so much a growth concern or an inflation one, or is it both at the same time, which actually is a central banker's nightmare if you have weakening growth on the one hand and exacerbated inflation on the other? Within that PMI data, it showed suppliers have faced the longest delays in more than 2 years in delivering raw materials to their manufacturing customers. So yeah, it's a growth story, but but it's an inflationary one as well.
Yeah, well, and it goes together, the stagflation, as you say, the worst nightmare for central bankers. Let's reset here for a second. We were talking earlier about real yields in the United States reaching a positive level for the second time this year. They have now reached the highest on an intraday level going back to March of 2020. We see them continuing to climb, now solidly above zero, 0.0531% to be specific. Tom Keene, I know you're listening and you want to hear 4 digits. Honestly, Kaylee, this to me is one of the biggest stories of the past couple of months. It has been the complete repricing in terms of the inflation-adjusted yield. Basically, the Fed is not going to be accommodative. They may still be accommodative now, but they're not going to be in the future, and that is what people are starting to really contemplate.
And I wonder how much of what we saw when the pain in the equity market really came in full force in April, the worst month for the NASDAQ 100 in particular since 2008. What does that index hold? A lot of really richly valued high multiple stocks that are threatened by real yields, not just higher real yields than we've seen, but positive ones as well. The question is, how far does that go, Lisa?
And to your point, I mean, looking at the NASDAQ, and NASDAQ futures are near the lows of the session, down 0.4%, moving down in tandem with real yields moving up. So perhaps a repricing as we go ahead closer to the open. Coming up on Balance of Power on Bloomberg TV and radio, General David Petraeus, chair of KKR. From New York, this is Bloomberg.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Live from New York City this morning. Good morning, good morning. What a week we've got coming up for you. The Federal Reserve on Wednesday and a payrolls report this coming Friday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, looking ahead to the Fed's next move.
The foregone conclusion the Fed goes 50 basis points.
The widely expected 50 basis point hike.
They have no choice but to hike 50 basis points.
People are heavily fixated on where rates are going to be.
But it's the longer term that's getting harder.
The path to a soft landing for the Fed is narrowing.
The Fed is in warp speed in terms of trying to get to neutral.
2.25, 2.5, maybe a bit higher. And I don't think anybody knows what the neutral rate is.
As for whether the Fed put is dead.
Oh, I think it's dead.
It's just in hibernation.
They'll signal more hawkishness and more rate hikes ahead.
The risk, I think, is maybe they don't slow down.
When you distort markets for this long, you have to pay the consequences, unfortunately.
At the May meeting, you're going to start to lay out more of the plan.
Joining us now, RB advisors Michael Kontopoulos, Zach Griffiths of Wells Fargo. Zach, first to you. Where is there scope for surprise this Wednesday? I keep asking that because everybody agrees we get 50 basis points. Where can we get a surprise from? What's your view?
Yeah, Jonathan, it does seem like everyone has coalesced around 50 basis points and an announcement of balance sheet runoff. We expect that will go into an effect in June. Perhaps it starts in May, but signaling by Fed Governor Brainerd, New York Fed President Williams indicated they preferred June. So as far as where the surprise could be, I think it would have to come down to Chairman Powell's press conference and whether or not he really indicates that 50 basis points at every meeting, at several meetings, what have you, that's going to be the key. Will they do 50 more than the twice that we expect? The market, I think, expects about 3 consecutive 50 basis point hikes. We're skeptical of that, but that's what we're going to be focused on for a potential surprise out of the Fed.
Michael, what's your take?
Yeah, I agree. I think the surprise has to be in the forward guidance and the rhetoric going forward. How hawkish are they going to be? How much are they going to, effectively admit that they're behind the curve and need to make up ground here on inflation? To me, I think that's the biggest wild card is just their acknowledgement that.
Okay, guys. Okay, traders position opened, as you can see, on euro against United States dollar. You still have chance to open at lower level. We opened at 105, 22.6. Okay, stay safe, stay with me, and I'll speak to you after when some changes will happen, when I will decide to place stop on profit. For all of you guys who got already our strategy, you know what to do, you know how to trade. If you're new in this game, follow me, stay with me. If you want, you can get the strategy. Otherwise, stay, copy this trade and make a profit as well as we do. Stay safe.
Then are they going to indicate that perhaps the terminal rate's much higher in order to be able to get inflation under control? And so I think, yes, the first 100 is clearly well telegraphed. We think they're going to go probably 50 in May, 50 in June, but the market already assumes that. The question is, what about later? What about later this year, right? How are they taking into account the more permanent factors of inflation? Are they taking it seriously finally? I think we could get some of those answers, and obviously that's what the market's going to be looking for.
And do they have a tougher choice, Zach? Do they have to choose at some point this year between capping inflation or supporting growth? Right now, they believe they don't have to make that choice because the growth, the data, as far as they're concerned, is still decent. This is what Priya Misra of TD had to say. I struggle with the notion that the economy can handle continued hikes beyond neutral and QT. People think that inflation could be sticky and that will not allow the Fed to slow down tightening, but I think the economy is not as resilient. Zach, what do you say back to that?
We think the consumer is still quite resilient, and to see these hikes that we expect over the next several months, and the economy should slow down a bit, but we think we continue growing around trend-like growth. We have year-over-year growth in 2022 at 2.8%, so I wouldn't even say that that's falling below trend, but on a quarterly basis, on a sequential basis, we do have it decelerating. So I think I'd say the consumer is more resilient. You do still have a lot of the stimulus of the past couple of years sitting on consumers' balance sheets. And so we think that gives the Fed the scope to really focus on getting inflation under control. And they've made it very clear that's priority number one, and nothing else is even close.
Big week ahead, not just the Fed on Wednesday, also payrolls on Friday. Bank of America coming out with a range of estimates, looking for an ISM close to 60, payrolls at 450, unemployment down to 3.5, a 50 basis point hike at the start of QT. Mike McKee, you're going to be a busy man.
Yeah, and it looks like the Fed is going to be able to get going, at least rather quickly, as the panel points out. It's not a question of what, but what's next. We're not only pricing in 50 basis points for this meeting on Wednesday, we're pricing in 50 basis points for the next 3 meetings. And then you get to 10 moves by the end of the year, 11 moves by the first meeting in 2023. That would put us at or slightly above neutral if you accept the Fed's 2.5% neutral estimate. And that would be a rather quick pace of tightening, the quickest since 1994. And now I feel like a game show host because, as you pointed out, John, that's not all. We've got not only the Fed on Wednesday, but the refunding announcement. Treasury is going to start selling bonds without the Fed as the ultimate buyer. Who's going to buy it? How much are they going to sell? That's going to be a really important question for the bond market. Payrolls on Friday. As you mentioned, watch average hourly earnings. Do we see a slowdown? Do we start to see some wage pressure easing? The Aussies and the British are going to be making rate decisions as well, and that's going to affect the markets because as they take stimulus out of the markets, forgot the word, it's going to affect rates. And then the wild card, do we get a Russian oil embargo? That's going to be a really big question because then oil prices go up, inflation goes up. Last time we went 50 was 2000, in March of 2000, and here's what happened. You can see where the red circle is what happened. Inflation did come down, but we also had the tech bubble burst. So which came first, the chicken or the egg? And then you can see the recession that we entered into. Does the Fed send us into that kind of recession again?
My Bank of America just published, and they said something that's pretty interesting. We're talking about where there's scope for surprise. The bar right now is so high for the Fed for the next couple of meetings because we're looking at 50, 50, 50, and maybe even 50 again. Bank of America say this: it will be hard for the Fed to out-hawk the market. A non-committal Powell on a 75 basis point June hike risks a slightly dovish market outcome. Do you think, Mike, that's problematic? That if we get a dovish outcome, you get a loosening of financial conditions because the Fed is just kind of battling this market, which is just trying to out-hawk itself over the last few months?
Well, you could get a bit of one, but the market's already pushed up rates, and we're looking at 3% for the 10-year pretty soon here. The market's already pushed mortgage rates over 5%, and we're seeing a slowdown in housing. So it may not matter that too much to the Fed, but I suspect that Jay Powell's not going to want to commit to 75 at any particular time. Be interesting to see how much of a commitment he gives to 50 at the coming meetings.
True. Mike McKee, thank you, buddy, as always. Michael, I'd love you to respond to this. Michael Kontopoulos, this line from B of A. It will be hard for the Fed to out-hawk the market. A non-committal Powell on 75 basis points in June risks a slightly dovish market outcome. Would you agree with that?
You know, I don't totally agree with that. I think if the Fed comes out with a 75 basis point, hike or announcement that they're going to do 75 basis points, I think there's plenty of room in the market for that to be priced in a higher rate environment. Listen, going to the previous question, Jonathan, about growth, I love Priya, ex-colleague of mine. She no matter what she says, it shouldn't be taken lightly. But I think this economy can actually handle higher rates. You look at most of the leading economic indicators out there, they're pretty strong, continuing jobless claims, building permits, et cetera. But you have to think, the economy is much less sensitive to interest rates today than they were, 10, 12 years ago. Variable rate mortgages are non-existent. Cash on corporate and consumer balance sheets are incredibly high. Debt's been termed out at low levels. Interest coverage is exceptionally high. And so, I think that to your question on 75 basis points, the Fed may need to do that just to start making some sort of impact to consumption in the real economy. And, that likely leads to much higher rates and, the market pricing in more hawkishness. And I don't think it's done pricing in the amount the Fed can ultimately go.
Michael, I want to follow up on that one. You wrote in your notes about that transmission mechanism to the real economy from interest rates, and you said that had diminished versus the past. But is it the opposite when it comes to financial markets? Are these financial markets more connected to what is happening at the Federal Reserve than they were in the past also? And does that present very different threats this time around?
I think that's spot on, Jonathan. When I look at the transmission mechanism, so to speak, It could be through housing. We already seen the mortgage rates north of 5%, as Mike just mentioned, and it could be through bubble assets. Assets that are long duration, private equity, crypto, consumer services, discretionary, tech, obviously, right? All of these long duration assets that thrived off of QE. How many times, have people been on Bloomberg over the last 12 years talking about TINA? There is no alternative. The massive amount of liquidity in the system. That is all going away. What worked for the last 10 years because of virtually zero interest rates and a relatively low growth environment is probably not going to work. We have higher interest rates, higher liquidity, right, and a better growth environment. And so, yes, I think the transmission mechanism actually could be quite different. And rather than being on the real economy, instead, it's through maybe a deflation of risk assets that, really were in a bubble for the last 10, 12 years.
So, Zach, do you agree? Do you believe that we are breaking out into a very different market regime that perhaps we still haven't fully got our hands around?
I think it's an interesting point, and when you consider just how quickly the Fed needs to act, how high inflation is, all these other cross currents from a geopolitical standpoint, I think it is difficult to really have a very clear view of where we go from here, and we certainly take that point to heart as we forecast rates out here. We're using a much wider range of yield targets, and I think that is something that's going to be a story going forward as we get a better feel for exactly how much the Fed will do, how quickly, and how inflation responds. I think that's the key thing. If you still have inflation near our targets of 5.3% headline on PCE and 4.4% on core, can the Fed really take its foot off the gas with those levels? And we doubt it.
Raises big questions about the Fed put. We'll add to this conversation a little bit later. Mike and Zach are going to be sticking with us. Equity futures turn around again. They were positive by a third, 0.5%, then they were negative. Now, they're unchanged, Taylor Riggs. I can't keep up.
John, and we're coming off of a really bad Friday. I don't know if you remember sort of the end of last week. We had a huge sort of bloodbath when it came to some of the big tech stocks. So that sort of sentiment, John, if you will, is continuing. Take a look at Amazon. You're off an additional 1.5%. Remember, you lost about $215 billion of market cap on Friday. That then was the second worst sort of one-day fall when you're thinking about all the companies and all the big sort of market cap that they have lost. So that theme, again, continues. I want to take a look at earnings, for example. Moody's, of course, here, one of those missing estimates, cutting the full year outlook, margin, cash flow. Another big theme here is we're thinking about cutting some of that forward guidance. Pfizer's another interesting one, John. You're off about 2.5%. You had some antiviral data when it came to COVID. That sort of missed the estimates. No statistically significant data coming out of that. And then finally, take a look at Activision. Of course, we've been following the Berkshire Hathaway annual meeting. Warren Buffett, of course, coming out and saying that he did indeed sort of was buying that stock ahead of that merger announcement with Microsoft. So shares there are getting a little bit of a boost.
Taylor, thank you. Lucky to have Taylor with us. Through to the opening bound this morning. Coming up, China's COVID-0 policy taking a toll in a big way on its economy.
Nobody can sort of walk away from China. China cannot be replaced. But at the same time, the policy that China's driving is so uncertain. The predictability of China is all of a sudden out of the window.
Lockdowns there straining global supply chains. That conversation up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells. no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Fed go?
I have everything on the table right now.
25 or 50 basis points?
If we think it's appropriate.
It could be 25, it could be 50, it could be 75, it could be 1.
We'll tell you what you need to know.
It becomes a question of how fast and how far do they go with rates?
Does he choose to de-emphasize parts of this forecast?
I'm blown away by the conversations we're going to have.
We're going to discuss all of this coming up.
Bloomberg Surveillance, the Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
Nobody can sort of walk away from China. China cannot be replaced. But at the same time, the policy that China's driving is so uncertain. The predictability of China is all of a sudden out of the window. We see already now members reshifting to source from other countries because they don't know if there's going to be another lockdown. The data set is very grim.
Said about right. It was absolutely terrible, the data from China going into the weekend. The stringent lockdowns clearly taken a massive toll on the economy. The PMIs plunged into their worst level since February 2020, with suppliers facing massive delivery delays. Joining us now is Damien Sassower of Bloomberg Intelligence. Damien, we can go through it together. 42 on a composite. This is the PMI. Manufacturing of 47, non-manufacturing of 41. It's pretty dreadful stuff, isn't it?
Yeah, the services figure, I mean, my goodness. But yeah, I mean, this is the worst we've seen since the height of the pandemic. And look, you know, we expected as much. What's interesting beneath the data, exports, new orders, all incredibly weak. So demand is off the record. It's just off the record in China. But really, the interesting point is construction activity. You know how Beijing is focused on infrastructure spending to kind of fuel that, you know, 5.5% GDP growth target. It ain't going to happen with this type of number. I think we had 52.7 in construction activity. And if you look at the CACtion, which, you know, is more small and medium enterprises in China, exceptionally weak. So across the board weakness. And again, you know, we were calling for a little bit weaker. So maybe there was a little bit of padding to the statistics, so to speak, if you listen to Leland Miller. But for all intents and purposes, this was just a very bad print, and it's not getting any better. I mean, Shanghai was supposed to be on lockdown for 5 days. We're now 1 month in, Jonathan.
We've got to talk about Russia a little bit later this week. We'll save that for later this week.
Oh, God.
Any reason to believe that China blinks anytime soon on its zero COVID strategy?
Absolutely not. I don't see any. I mean, look, you know, all indications point to the fact that they are not going to be providing direct support to households. They have not addressed the property sector. Yes, they said they're going to kind of spend on infrastructure. They're going to try and support growth. Yes, they're going to try and alleviate some of the tension in big technology. But at the end of the day, without direct support to households, I don't know how demand's going to come back online, Jonathan.
Damien, great to catch up with you, buddy. As always, looking forward to later in the week to talk Russia. This is the situation at the moment then. First 20 minutes of this program, we've been talking about the Federal Reserve, we've been talking about China. Who blinks first? Big market correction, will the Fed blink? Big growth correction, will China blink? This is what Standard Chartered have to say. Will the FOMC blink? We don't think that's a possibility until later in Q3 22. Will China's policymakers abandon their COVID zero policy? We don't think that's possible until at least after the 20th Congress of the Chinese Communist Party, likely to be held in the fall. Back with us, Zach and Michael. Zach, your view on this. Will the Fed blink, given what's happened with markets? Will the Chinese policymaker blink, given what's happening with their economy?
We don't think the Fed will blink at this point. You'd probably need to see a much more substantial drop in equity prices and tightening in financial conditions. And I agree with the note you just read. I don't think China's going to blink anytime soon. And if you think about the 20th Party Congress, that's going to be another 5-6 months down the road. So we think that's an appropriate time frame to consider where China won't blink and even the Fed won't blink for different reasons.
Michael, do you agree?
Generally speaking, I agree, Jonathan. You know, in terms of the FOMC, I think what they're going to be mostly looking at are credit spreads. I don't think they really care, quite frankly, about tech and some of the bubble assets that I mentioned earlier. What they really care about is credit spreads and what's happening there and the transmission mechanism from credit to the real economy. You know, remember in 2018, when the Fed blinked, they weren't fighting inflation, right? And they had already gone through a hiking cycle, so they had arguably passed the neutral rate already. That's a very different situation from what you have today. So we think it's quite some time, unless credit markets push back really, really meaningfully. In terms of China, I think that's spot on. They have to wait, but when they go, they're likely to go pretty hard.
And Michael, I know you're careful with your words. You said credit spreads. Spreads have been contained, but total return in investment grade, for instance, it's been pretty ugly. Can you run me through what matters and what does not matter?
Absolutely. So far this year, it's been exactly what you said, a rate story more than a credit risk story. I mean, you look at credit fundamentals, and they're actually quite solid. Leverage, particularly net leverage, has collapsed. You have huge amounts of cash on balance sheets, and earnings growth is pretty substantial. Interest coverage is at all-time highs. The ability to pay your debt, the coupon on your debt through earnings, that's at all-time highs as debt has been termed out at really attractive levels. And so from a credit risk perspective, which is the spread that you're earning, of course, you know, things look reasonably good. Now, they've widened a little bit, but that's because of the volatility in rates and the volatility in equity markets. And if credit investors don't like one thing, it's volatility. They want certainty of the payment of their coupon and ultimate payment of principal. But, you know, given what we've seen on the equity side, credit spreads have remained very, very well behaved. It's really an interest rate story, and the interest rate is what's killing particularly long duration investment grade and other areas of the investment grade market. So we would much rather take credit risk here than interest rate risk.
Does that mean loans over, say, high-yield bonds? I caught up with Vishy Tripatura of Morgan Stanley, who had that view at the start of the year. He's now changed his view. Would you still be comfortable with that?
You know, we've liked shorter maturity high yield. There's too much default risk priced into the front end of the high yield market. You're earning nearly 7% in that portion of the high yield market, so it's a very high carry. So the compensation is very, very good with low duration. And so low duration high yield, i.e. short maturity with a high coupon, we think is actually more attractive than floating rate. But we do like floating rate paper in general, particularly, you know, AAA CLOs, for example. We think there's great value in that area of the market.
Final word here, Zach, goes to you. How you think this Fed responds this Wednesday to what's been happening in this market?
50 basis point hike. We have the balance sheet announcement coming this week, but going into effect in June. And we think Chairman Powell will keep his foot on the gas as far as indicating that they are going to need to tighten policy. And maybe he hedges his bet a little bit with an emphasis on data dependence around inflation. But given our outlook for inflation remaining persistently well above their 2% flexible average target, we think they are going to mean business for this meeting and the next several meetings, and aren't going to blink unless we see a really material tightening of financial conditions outside of what they see as necessary to bring inflation down.
Just a massive week lined up. To the two of you, thank you. Zach Griffiths, Michael Kontopoulos, lining things up for the week ahead with the Fed on Wednesday and payrolls this coming Friday. Coming up in the morning calls and later, looking back to a NASDAQ which just posted its worst monthly decline, going all the way back to 2008. We'll be catching up with Alicia Levine of BNY Mellon to get her calls on this market, to lift the lid on the index and get you some sector price action. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Coming off the back of the biggest monthly decline on the S&P going back to 2020, on the Nasdaq 100 much worse. You've got to go all the way back to 2008. Kicking off May with futures just about positive, 0.1% on the S&P. On Nasdaq futures almost there too, up by almost 0.1%. That's the price action. Here are your morning calls. First up, Piper Sandler upgrading Comerica to overweight, seeing limited downside to consensus estimates. That stock is up by more than 2%. Wedbush removing Amazon from its best ideas list, pointing to numerous question marks following the company's quarterly results. The horse and the barn door and all of that good stuff. That stock is down 1.3%. Rosenblatt cutting its Apple price target to 168, expecting China headwinds to continue fueling supply disruptions. We're negative there, just about 0.25%. No drama there. Coming up, Big Tech recording its worst month since 2008. BNY Mellon's Alicia Levine telling investors to steer clear of the lockdown winners. We'll catch up with Alicia next. Your opening bout just around the corner.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bout this morning. Good morning. Leaving April behind, it was brutal. Let's kick off May. Futures unchanged on the S&P. On the Nasdaq 100, we're negative by around about 0.1% there. On the Russell too. Last month, the ugliest on the S&P going back to 2020. On the Nasdaq, as you know, going back to 2008. Let's the opening bout, switch on the board and get to the bond market. Equities down last month, bonds down too. Yields higher. Higher again today by 3 basis points. We turn around here just a little bit. 296.90 on a US 10-year. In the FX market, euro dollar clinging, holding on to 105. Last month was ugly for the euro, 105.07 right now, negative 1/3% on that currency pair. And crude turning lower as well. We're down by a little more than 3% to 101.24. There's the opening bow then. Let's get you some movers. Here's Candy Lines.
Well, I actually have a positive technology-oriented mover for you today, John, on the back of earnings. That would be On Semiconductor, delivering a first quarter beat and guidance for the second quarter that came in handily above analyst expectations. They say earnings going as higher as $1.32 in the current period. The street was down at 105, so a nice 2% lift for that stock there. But of course, things didn't go so well for Amazon with its disappointing outlook last week. Not looking great this morning either. After a 14% drop on Friday, the worst day for the stock since 2006, it's down another 1.4% this morning. Wedbush removing the stock from its best ideas list today. Also lower, Pfizer data over the weekend revealing that Paxlovid, which is its pill for treating COVID-19, failed to show benefit as a preventative therapy in a trial. So that stock's down 2% ahead of Pfizer's report tomorrow morning before the bell. And finally, in the airline world, we got 3 players involved here. JetBlue trying to buy Spirit Airlines, sweetening its offer, including a big breakup fee and divestiture commitments. Then Spirit saying, nope, we still prefer Frontier's bid for the company, which actually was lower, $2.9 billion. That stock down 7%, trading at $21.96, about $4 below Frontier's offer price of $25.83, John.
Kelly, awesome this morning. Appreciate it. Kelly Lines there, just breaking down some of the movers. I'll break down some of the sector price action for you about 1 minute and 50 seconds in. We're positive on the S&P by 1/10. The leadership is pretty defensive at the moment. Utilities and staples, utilities up 7/10, staples as well. At the bottom end of this market, the other performance coming from energy, down 0.6%. Consumer discretionary as well, down by about 1/3. Luke told Jim Paulson, looking at inflation and expecting it to continue to drive equities lower. He says the following: all the fears we have about a Fed policy mistake and recession are tied to concerns about inflation. And that's been reflected in the stock market this year. If inflation continues to rise, then the downside risk for stocks is double digits. And Taylor Riggs, let's face it, we're basically already there.
Yeah, I mean, certainly on some of the individual stocks, John. I mean, I'll just start broadly. You mentioned the Nasdaq 100 just had its worst month going back since 2008. Friday alone was the worst day since September of 2020. But you're right that underneath the surface, I mean, in April alone, Netflix is off 50%. We talk about the year. I think that number is closer to 60, 70%. Pretty much nowhere else to hide when you think about NVIDIA, Match, AMD, PayPal, Amazon, you name it, right? April really was a tough month as you're facing higher inflation and, of course, the rising interest rates that follow that. Change of the board, I think what's interesting, you've been doing this a lot on your program, is sort of the defensiveness of this nature. On record, you had staples outperforming discretionary in April, sort of the huge divergence that we continue to see. I would argue that perhaps maybe staples are those, of course, that can pass on some of those higher costs to consumers. And at least for now, consumers, they are doing okay, but I do wonder when you start to see a pivot, definitely more towards staples and away from some of those discretionary items, as typically budgets are fixed and you only have a finite amount of money to use. I think sort of quickly here, one thing we've been talking about, John, when we think about this is real wages. Yes, they are still negative. We've talked a lot about the big wage gains, but if inflation is still growing faster, then the wage gains are not enough to keep up with that.
Taylor, thank you. I just wanted to pick up on something Taylor said and fold in the work from Morgan Stanley and Mike Wilson on the defensives. This is what they said last week, quote, "We suggested the bear market was entering the phase when virtually nothing would work, even defensives." They added to that this morning, saying the market is currently so oversold, any good news could lead to a vicious bear market rally, but we want to make it clear this bear market is far from completed. The words of Mike Wilson and Morgan Stanley this morning. I think that quote on the air is wrong, but Morgan Stanley, Mike Wilson, just to be clear on all of that. I want to turn to Alicia Levine of BNY Mellon, recommending industries with pricing power and saying the following, pointing to high-quality defensive growth sectors such as energy, materials, and industrials. Alicia joins us right now. Alicia, just to come to you and start with the index story last month, down almost 9% in April on the S&P. Worst month going back to 2020. The Nasdaq 100 down 13%. Worst month back to going back to 2008. And your line here, avoid passive investing in 2022. Alicia, I think we have to start there. My audience has heard that year after year after year after year. Why do you believe it's true now?
So, good morning, Jonathan Farrow. And yes, April was the cruelest month, which is not normally the case in markets, as you know, but it was this year. Look, part of the reason that we say avoid passive investing is that there are going to be very few sectors that can come out of this inflation rise and the tamping down of inflation by the Fed, and they're just not large enough in the S&P to drive the index upward, right? So they can stabilize the index, but it's not sufficient. And if you look at what's happened with multiples just in the first 4 months of the year alone, the forward 12-month went from 21 times to 17 times, which is the 25-year average of the S&P. That was all done in 4 months, and it was mostly done on the back of growth stocks, not on the back of value stocks. And so you had a severe multiple compression in growth, and that's what drove the S&P lower, not so much the compression in the value. So, you know, we'd say here that you should really stick to sectors that can earn through inflation, that have sticky pricing power, and that we can see to the other side.
The breakdown, as you point out, just the weightings, I think, tell that story pretty easily. Energy makes up 4% of the S&P. Apple makes up 7% of the S&P. You can tell which is going to be more important. From a sector basis, let's build on that then, Alicia. What do you want to own? What do you want to avoid?
So we've been talking about owning CapEx here. And so it's not really sector specific, but it really is two things. It's the hard asset CapEx, because we do see a reshoring of supply chains to the U.S., not in its entirety, but enough to drive investment and enough to drive earnings in the companies who are the recipients of that. And also on the tech side, CapEx, because clearly digitization of pretty much every industry is happening, and happening rather quickly, most notably in retail, actually. So those companies that are the recipients of CapEx, which we still think happen, will do very well. We just think you have to be very careful here, because what we saw during COVID, that it wasn't just certain household goods that over-earned, but it happened within the tech sector as well, as we saw last week in some of those earnings. And so when companies have over-earned, they're going to be punished by multiple compression until you weed all of that out of it to where you were in February 2020. The pain is not fully done yet in some of those sectors, we think. So you got to go with the names that really were somewhat pandemic losers here. And that means the reopening trade for now.
Alicia,
the interesting thing here, Jonathan.
Can I just jump in just on defensives? Forgive me.
Yeah.
Morgan Stanley and Mike Wilson said that even defensives won't work in this market, and we saw evidence of that in the last couple of weeks. Do you push back against that in any way, shape, or form?
Look, I push back because the money has to go somewhere, and we tell our clients to be invested, and so therefore we think the defensives will outperform the higher growth and the higher multiple names, and so we are invested there. So utilities and healthcare and staples, we have overweights to that, and we still like energy. Energy may have spiked on the hard asset on WTI, but we think that prices stay higher simply because the supply issues coming out of Europe are not going to be easily fixed. And supply takes a long time to get going here in the U.S. May happen eventually, but it's not going to be overnight.
Let's spend a bit more time on the banks as well. That's something that didn't work out in a way most people anticipated. Alicia, I've lost count of the amount of guests that came on this program at the start of the year and said, rate hike cycle is coming, get in front of the banks, get long those names, things are going to be good. Hasn't happened. Why hasn't it happened? And do you think it changes anytime soon?
Yeah, look, it hasn't happened because the fears of the cyclical slowdown were coming at the same time as we were expecting rate increases. So the fears of stagflation were right on top of the inflation ramp and the Fed hikes. So that's why it didn't happen on the bank side, because of the fear that the cyclical side was going to weaken the fundamentals there. Have they come down enough? Probably not yet. Probably not yet. I mean, the way we get out of this is that, inflation has to look like not just that it's peaking, but it's starting to come down on its own. So we don't want just peaking at a higher level, but starting to come down on its own without the Fed having to go past neutral. And we need earnings to hold up, earnings and margins. And if that holds up, then you can stabilize the markets. And sentiment is so universally negative, while starting this month, corporates are back in there buying back stock to the tune of billions, 5 billion a day. So we think probably in the short term you have a nice rally here, a nice tactical rally, but the fundamental side is not yet done. We're not done because inflation has to look like it's coming down a bit on its own.
Is that just a nice way of saying a bear market rally, a nice tactical rally, Alicia? Is that what that is?
I'm not gonna be led into that, Jonathan. I'll say this. We're sitting right at the intraday lows of February. A lot of damage has been done.
Yeah.
And that means best case scenario, it takes time to repair. And I don't think we're done discovering that some of these companies that are sort of hallmark companies out there had a bit of a pandemic bubble in parts of their business, not the entire business, like the classic pandemic winners out there, but parts of the businesses were probably pandemic winners, and that has to be wrung out of the system, as we saw last week. It just has to be wrung out. Doesn't mean the whole business it had over earned, but part of it did. And we're not done with that yet. We're not done.
Well, Alicia, if we're not done with that, I just wonder, is it useful even looking at aggregate earnings through Q1? Is that even useful if we're not even done with the price correction? Because Deutsche Bank pointed this out. They said, despite concerns about cost pressures, margins remain elevated near record highs amidst robust sales growth. Margins for the medium company have, in fact, risen in Q1. It's hard to reconcile the earnings with the overall price action, but as you point out, this is about a correction of price and wringing out some really overinflated valuations over the last few years. So, Alicia, how instructive are the earnings of Q1?
So the earnings are very instructive, and it's one leg of the stool here. You need to have earnings hang in there. You need margins to hang in there, because without that, then we really do have a bear market. And the reason we're not actually calling for much further downside here is simply because we think the fundamentals actually are fairly good. And the real economy, despite the GDP print, which we know was artificially depressed because of the trade issue, also pointing to the overbuying on the goods sector, despite that, the economy still is coming in fairly well. You need the fundamentals. You cannot ignore it, because that's part of what gives you where the multiple is, right? The multiple is whether or not have we reached a place where margins have compressed enough and we can move forward, or are we going lower? We're at 17 times now for the S&P. We're at 21 times on the growth side. Does that go lower? That's really the question, not so much on the earnings side. It's the multiple side here.
Alicia, brilliant, as always. Come back soon. Don't leave it so long. We've got to do this again. Alicia Levine there, FBNY Mellon. Thank you. Coming up, Speaker Pelosi making an unannounced visit to Ukraine.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone.
That conversation up next.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's Bloomberg.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone. And so our commitment is to be there for you until the fight is done.
Speaker Pelosi sending a message of unity as the divide in Europe over Russian gas intensifies. The EU meeting in Brussels to settle their differences, with Hungary willing to veto an oil embargo and Germany looking for a compromise. Joining us now, Maria Tadeo in Brussels, Anne-Marie down in DC. Maria, first to you. How close are we, or far away, are we from a deal over this kind of thing?
Well, Jonathan, you see how everything is changing here because, of course, the biggest issue was Germany. But now the Germans say they are open to potentially dropping this veto. I spoke with the German economy minister, Robert Habeck, just a few minutes ago, and he said if we do it gradually, and when we talk about an embargo, we should be careful and say this is a light embargo, Jonathan, because it would not be overnight and it would be gradual from now until the end of the year. But he says Germany would not oppose this. The issue is now turning to Hungary and, of course, and Viktor Orban, who says, well, they don't see how this would put an end to the war. They say it would have a big detrimental impact on their economy. And remember, every decision here gets taken by unanimity. You have to agree the EU 27 as a bloc. But I would say one thing, Jonathan, when you look at the Hungarians, throughout this process, they have voted in favor of all of these sanctions. So there is a difference between what Viktor Orban says in public and what he does behind the scenes. And until now, this unity is holding. Whether it happens this week, tomorrow, by the end of the month, that is unclear. There is no specific deadline on it. This, we understand, may not even happen today. But you can see that the sense of direction now, it is clear to see this oil embargo taking place. We talk about oil, not gas for the time being. I put that question to the German economy minister, and he was very careful to say this would just imply oil, not gas. The reason was pretty obvious. Germany still imports 35% of gas. Unplugging from that is very difficult.
And the latter is far more important than the former, as we know. AMH, something's developing stateside that perhaps isn't getting talked about enough. Just slowly, output in America is creeping higher, just short of 12 million barrels a day. Ed Morse's City earlier on today said we can get back to 13. Do you anticipate we will start to see results here? Because as someone reminded me, crude might have come back down, gas prices haven't really, and the price of flying jet fuel hasn't in a big way either. Can we make some changes here stateside anytime soon?
And diesel as well, and that's why you see this is such a big part of the inflation story, because diesel is what trucks run on, and of course that is really the heart and soul of how you get groceries and goods around America. What you are seeing, Jonathan, what the administration wanted to do is they made this ask to oil producers to pump more. And what they would talk about, I know Amos Hochstein talked about this with you, Tom and Lisa, about a 6-month gap. And that is why they wanted to tap the SPR to hopefully hold them over to when later in the year, they do believe that there's going to be more investment and more production coming out of the United States. We also should note there is an OPEC meeting this week, Jonathan. So potentially we could see action from the OPEC Plus cartel, and potentially that will drive some direction in what we see from other major producers.
Anne-Marie, down in D.C., alongside Maria Tadeo in Brussels, as Trevor Noah, the comedian, said over the weekend at the White House Correspondents' Dinner to the President. So you've come into office, and since then, things are really looking up. Gas is up, rent is up, food is up, everything is up. To the two of you, thank you. Ed Morse of City weighing in on some of this, saying it's unlikely the EU will reach an agreement. Take a listen.
If Germany is not going to use its veto power in the EU, Hungary certainly will. So we don't think there's going to be an overall European community agreement on not pulling in natural gas or oil from Russia. We don't think the Russians going to pull back because income is better than no income.
Julian Lee joins us now from Bloomberg. Julian, if it's not Germany, it's Hungary. If it's not Hungary, it's Germany again. Any chance of a European-level deal on this kind of thing anytime soon?
I think it's looking very uncertain at the moment. I mean, you know, we have seen the Hungarians repeatedly saying that they won't go along with sanctions, and yet every time they have done. I think energy, and at the moment we're looking only at oil and not gas, as you said, that may be a sticking point. But in some senses, you don't really need an EU-wide embargo. If Germany decides that it's going to stop buying and winds down its imports, if some of the other big importers of Russian oil do the same, it doesn't really matter whether that's done through the EU or not. What matters is who's buying.
Julian, you go a little bit deeper as well, beyond just Russian crude. We took a little snippet of your recent column, and this was the quote we pulled out. Putting restrictions on Russian crude is one thing. Trying to stop the sale of Russian refined products is much more complicated, in part because it's not clear what can or should be included. Julian, can you just speak a little bit more on that? Because I'm not sure how familiar many of us are with that particular story.
Yeah, I mean, it's very easy to see what is Russian crude and what isn't. There are, there's one perhaps slightly ambiguous grade that's 90% from Kazakhstan and 10% from Russia, but I think that's very likely to be left out of any sanctions, and quite rightly too. But when you get to refined products, it gets a lot more difficult, particularly if you start to think about this big movement that we're seeing of Russian crude going to refineries in Asia, particularly in India, because those refineries then re-export a significant proportion of the products they make. So is a cargo of diesel that is made in India or processed in an Indian refinery that is running Russian crude, does that diesel then fall under sanctions or doesn't it? Is it Russian diesel or is it Indian diesel? And that, I think, becomes a much more complicated question. My suspicion is that those kinds of products will probably be left out, because if you include those, then maybe you start creating real problems in terms of diesel shortages.
Julian, wonderful to get your thoughts and some clarity on a really important topic, as we've gotten used to in Europe for a long, long time. They talk for a long time and then end up with a fudge and a suboptimal outcome. And to Julian's point, maybe that's what this ends up like as well. Julian Lee there of Bloomberg Intelligence and Bloomberg Opinion. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
26 minutes into the session this Monday morning. Good morning. Kicking off the month of May with equities just about positive by 0.1% on the S&P and the Nasdaq up by 0.5%. That's the price action. Here's your trading diary. At the top of the hour, the ISM manufacturing number, US factory orders and an RBA rate decision on Tuesday, a rate decision from the Fed and a Powell news conference on Wednesday. The Bank of England with its own rate decision this coming Thursday. And finally, we round out the week with a payrolls report in America. The estimate so far, moving target, of course, in our survey, the median estimate 391,000 from a previous number of 431. Big week ahead. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in five stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.